Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to closing bell here in the U.S. And you're taking a look at an S&P 500 where the rally has just dissolved, Romaine. You take a look where the benchmark sits right now, currently 0.4% lower. It's the same thing, too, if you look at big tech, the NASDAQ 100 off by about 0.3%.
A lot of movements going on in the Treasury space as well. Awaiting comments out of Jerome Powell, speaking at an IMF meeting, now getting those headlines coming out right now. Jay Powell saying that the Fed will continue to move carefully and that he's not confident that we've achieved stance to hit 2% inflation. Powell also saying that the Fed won't hesitate to tighten more if appropriate. The comments coming out of prepared remarks that Jay Powell, the chair of the Federal Reserve, is set to give at an IMF event in Washington. Michael McKee standing by right now, our Bloomberg International Economics and Policy correspondent, with more details on what we've learned. Mike, what do you got?
I think, Romaine, that the Fed chair is sending a bit of a signal to the markets not to price in rate cuts too soon by talking about the fact that they are not certain that they've achieved a sufficient restrictive stance yet. He says they're gratified by the progress that they've made with inflation, but the process of getting to the target still has, in his words, a long way to go. They expect growth to moderate, but if it doesn't, that could harm the inflation fight and cause them to need to raise rates as well. They will not hesitate to tighten policy further, he says, if it becomes appropriate to do so. And they are going to move carefully to address the risk of being misled by a few good months of data. Don't take that seriously, and don't take the risk of over tightening too lightly. So sort of a hawkish tilt to the speak. Nothing new he has not said in the past, but the way he's framing it is maybe a little bit of pushback to the markets.
All right, Bloomberg's Mike McKee, you're going to be back with us. Stay close. Let's bring in right now Diane Swonk, chief economist over at KPMG. And Diane, let's just go through some of these headlines again. Of course, Powell saying that not confident we've achieved stance to hit 2% inflation. The Fed won't hesitate to tighten more if appropriate. Just on first blush, what's your reaction to these comments and the idea that maybe he's pushing back against market pricing?
I think that's exactly what he's doing. I think you've already seen this week, Lori Logan has come out and said, the one who, first talked about term premium coming back into the markets, the one who headed up the New York Fed trading desk. She's very aware of what the tightening is in the Treasury bond market. And as someone who's aware of that, is now worried that we might be undoing some of that tightening to the point they may need to raise rates again. And this has been always what the tension was. We talked about it the day of the meeting, that even though, there was a hawkish tilt to the statement and that they left their options on the table, there was a sense that he took December off the table in terms of a rate hike, and markets rallied because they really got the sense that, okay, financial markets are now doing it for him. Well, guess what? The irony is the more that financial markets rally and the bond yields come down, we've seen a big move down in mortgage rates over the last week. That's really important because that undoes some of the tightening the Fed thought it would still have in the pipeline in terms of really bringing inflation down below 3% to its 2% target. And what some in the Fed are worried about, there is some signs that even though we've seen the progress we have in inflation, that it could stall out around 3% instead of get it all the way down to 2%. They really want to restore purchasing power in the U.S. and take inflation out of the equation in terms of consumers' decision making.
This gets to the broader question, Diane, and I know a lot of people have been very dismissive of the idea of changing the inflation target, or at least, I guess, setting up a little bit more flexibility around it. And I know they've gone from a hard 2% to 2%-ish here, but does the Fed maybe when they get on the other side of this, another rethink of that target?
I think once we get on the other side and we've achieved that 2% target, then you can think you can't move the goalposts in the game while you're still playing it. You need to finish the game and then think, what should the rules of the game be? Where should the goalpost be? What is the optimal target for inflation in the economy. To be honest, we know that 2% was a somewhat arbitrary target in the first place, and they couldn't even get up to it for a decade following the global financial crisis in 2008, 2009. So yes, they will go back and revisit and do a very hard look at, really think about what is optimal. I also don't think we're going to see anyone move off that 2% target until other central banks do so as well.
All right, in conversation right now with Diane Swonk over at KPMG. You see there on your screen right now, seated there in the middle roughly is Jerome Powell, the chair of the Federal Reserve, alongside Ken Rogoff of Harvard, Gita Gopinath, of course, the chief economist, first deputy managing editor, I should say, director over at the IMF, and I believe that's Amir Yaron over from the Bank of Israel, and the moderator there that you see is Pierre Olivier, of course, a director of the research department there, Katie.
And you take a look at the market reaction right now, Diane. The two-year Treasury yield breaking above 5%. We know it's been extremely volatile across the curve. But when you go back to what the market has done since the Fed meeting, that undoing of the tightening in financial conditions, you add that together with what we've gotten from Powell so far today. Would you say that December is on the table right now?
I think they have to leave December on the table. Whether they move in December, we don't think they will, because we think actually there's going to be enough noise surrounding whether or not we have a continuing resolution at the end of next week, whether or not we have a government shutdown. These are all things that feed into the bond market, and could buoy bond yields in terms of our own political dysfunction. So you add all that together. I don't think they'll move in December, but they've got to leave the option on the table and make that meeting live to keep the bond market where they need it to be, so they don't have to move. So it's a really tough balancing act to be able to get that message across.
I'm curious, when you look at about how far we've come in this rate hiking cycle, and the idea, Diane, that the economy overall seems to have held up relatively well, I mean, with the caveat that there might still be some lagged effects that could sort of appear here. Do you think that the approach that the Fed took and I guess the pace of the hikes and the way that they distanced them out, that ended up being a wise decision, particularly in the face of a lot of criticism that they should have started early and maybe even been more aggressive than what they were?
So I do think they, I was one of the ones saying they should have started earlier, that we were going to get a more persistent inflation. But let's do the counterfactual. If they had started once we realized inflation was more persistent, if they had started then, they still would have probably only gotten 0.75% in the pipeline before they got to that March meeting where they actually finally did lift off in rate hikes. So that's not a lot more. If you think about the counterfactual here, you wouldn't have gotten that far, and you still would have had a lot of heavy lifting to do. What's been stunning is how rapidly it's come down now, but also understanding that it does look like, we don't know, we still got only a few months of data, had some great improvement last month, not as much improvement in core services inflation, a lot of medical related inflation coming down the pipeline. The Fed knows that. They're worried about getting stuck, and they don't want to get stuck. But I think it is important that they went rapidly, given where they were and the kind of inflation we were dealing with. They were not alone in terms of moving aggressively. That said, it was hard, and there still are. It showed up in the bank surveys that we saw from the Fed this week. Yeah. There are some interest rate risks still out there, and I think that's what the Fed is sort of looking at.
All right, Diane, just stand by. Diane Swonk over at KPMG. Let's go now down and listen to Jay Powell at the IMF.
U.S. monetary policy in the current global inflation episode. So I'll begin by briefly addressing the U.S. outlook, and then I'll turn to three broader questions raised by the historic events of the pandemic era. So to begin, U.S. inflation has come down over the past year, but remains well above our 2% target. My colleagues and I are, of course, gratified by this progress. But we expect that the process of getting inflation sustainably down to 2% has a long way to go. The labor market remains tight, although improvements in labor supply and a gradual easing in demand continue to move it into better balance. GDP growth in the third quarter was quite strong, but like most forecasters, we expect growth to moderate in coming quarters. Of course,
Jerome Powell, by refusing to treat climate change like a systemic risk that you are putting us
Thank you very much.
All right, we're just listening right now to Jerome Powell, the chair of the U.S. Federal Reserve. He began to make prepared remarks at an event in Washington with the International Monetary Fund. While he was speaking, it does appear that some protesters did try to take the stage there. You heard them in the background making some sort of comments about climate change. We're, of course, going to keep tabs on what's going on down there. And as soon as that panel resumes, we will go back to it in full so you get a chance to hear not only what Jay Powell has to say, but, of course, the question and answer section that is scheduled to start a little bit later in the afternoon. Still with us on set here in Studio 2 in New York is Michael McKee, our chief international economics and policy correspondent. And we got a little taste, I guess, of what Jay Powell had to say, both from the prepared remarks that just came out and the brief introduction that we got there before he was interrupted, which seems to be a regular thing these days. I felt like the last time he gave a speech over at the Economic Club in New York, that was also delayed.
It was also delayed by climate protesters. I'm not sure what they think they're going to accomplish by interrupting the Fed chairman, but they don't get much airtime because they get kicked off. I'm a little surprised that this is at the IMF and they got through security. But
yeah, that's a whole nother topic of conversation here.
Exactly.
Let's talk about Fed policy, and I guess where right now we are with regards to, I guess, this whole rate hiking cycle and the big decision that the Fed now has to make either at the next meeting in December or maybe you push this out into next year of really flagging to the markets. If they are indeed done, do they flag that publicly?
Not for a long time, because they don't want the markets to price in too many cuts, because you get that effect that Diane Swonk was talking about, where financial conditions ease, and therefore the Fed has a tougher job to do. And today, you could see in Powell pushing back what's happened to the curve. It's gone up, rates have gone up, and that is what they would prefer to see. So the trick for them is going to be telling people we think that things are going in the right direction. In other words, we're not planning on moving anything, but we could. And moving up rates is much more likely than moving down at this point. The risks are skewed to higher inflation, stronger growth, and so we're going to stay poised to react to that.
Yeah, someone needs to tell some of the folks in the markets that.
Well, you're looking this morning and the market's just not paying attention to Chairman Powell. He came out at his news conference last week and said, we are not thinking about raising rates. We are not talking about raising rates. And the next morning, or cutting rates rather, and the next morning the market priced in more cuts and sooner.
Yeah.
Well, Mike, stay with us. Let's bring Diane Swonk back into this conversation, of course, the chief economist over at KPMG. And you just heard Mike reference some of the cut pricing that's come into the market. It's not just that maybe traders have taken December out of the equation. The pricing for cuts in 2024 has definitely ticked up in the week since that press conference. Of course, we'll hear more from Jerome Powell coming this afternoon, but when you think about the Fed's stance and the stance it's going to take to get back sustainably to 2% inflation, where does that put potentially the first cut, and does that come in 2024?
It comes in 2024, but I think Mike's exactly right. The Fed's not going to give its hand on when it comes until we get really close to it, because otherwise they'll undo the progress we've made, and they don't want to do that, and it'll force them to have to raise rates rather than cut rates. And I think what we saw coming out of the conference was, this sort of the reading that Jay Powell was pleased with where things had gone and pleased with market pricing, and then the market repriced. And, they were pleased with the pricing that it was in the second half of the year, around the turn of the year. I think June, July is a reasonable time to see a rate cut. But the descent on rates is going to be much more gradual than the ascent. And they also want to get that message across. I think it's really important that the markets, they repriced when Powell was actually sort of affirming that he was happy with where prices were and where financial conditions were. And then they undid it. And I think that's where the tension is for the Fed. And that's a very tough place to be. And it means they've got to keep the threat of another rate hike out there until they see a real clear path to 2%. That means getting below 3% consistently. And I don't think you're going to get there until the earliest June and probably July, between June and July, when they do their first cut.
And of course, Diane, you know this well, that there's reasons to cut rates other than maybe an economic downturn. Maybe the Fed wants to get somewhere out of restrictive territory, somewhere closer to neutral. And I know it's an impossible question, but when you think about this economic backdrop, the pace of inflation's descent so far, where do you think neutral is in this environment?
That's a great question, and it looks like the Fed is already moving up its estimate of what the non-inflationary and neutral rate of the Fed funds rate is. I think it's probably a little above 3. Remember, when we were at the end of the last expansion in February of 2020, we had, rates that were below 2. So we're talking about by the end of maybe the earliest, the end of 2025, beginning of 26, getting back to neutral, and neutral being something that could be above 3 instead of below 2 prior to the crisis. I think that's really important because the message is we went through the proverbial looking glass into an alternative universe, and there is no fairy tale here. We don't get to wake up like Alice in the study with our kittens in our lap and the world restored to where it was.
All right, Diane, let's try this one more time. Diane Swonk sitting by with us here as we listen in right now to Jay Powell, the chair of the Federal Reserve.
You expect growth to moderate in coming quarters. Of course, that remains to be seen, and we are attentive to the risk that stronger growth could undermine further progress in restoring balance to the labor market and in bringing inflation down, which could warrant a response from monetary policy. The FOMC is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. We are not confident that we've achieved such a stance. We know that ongoing progress toward our 2% goal is not assured. Inflation has given us a few head fakes along the way. If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening. We're making decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity, inflation as well as the balance of risks, as we determine the extent of additional policy firming that may be appropriate to return inflation to 2% over time. And we'll keep at it until the job is done. So with that, let me turn to the 3 questions that I've posed that have arisen from the receding but still elevated inflation we're experiencing today. The first question is, with the benefit of 2.5 years to look back, what we can say about the initial causes and ongoing policy implications of the current inflation. After running below our 2% target over the first year of the pandemic, core PCE inflation rose sharply in March 21. Economic forecasters generally did not see this coming, as shown by the February 21 survey of professional forecasters, which showed core PCE running at or below target over the subsequent 3 years. So the real-time policy questions for policymakers were what caused the high inflation and how policy should react. And at the outset, many forecasters and analysts, including FOMC participants, viewed the sudden upturn in inflation as mostly a function of pandemic-related shifts in the composition of demand, a disruption of supply chains, and a sharp decline in labor supply. The resulting supply and demand imbalances led to large increases in the prices of a range of items most directly affected by the pandemic, especially goods. In this view, as the pandemic abated, our dynamic and flexible economy was likely to adapt fairly quickly. Supply disruptions and shortages would diminish, labor supply would rebound, aided by the arrival of vaccines and the reopening of schools, elevated demand for goods would shift back to services, inflation would ease reasonably quickly without the need for significant policy response. Indeed, although monthly core PCE inflation spiked in March and April of 21, beginning in May, it declined for 5 consecutive months, providing some support for this view. But, of course, in the fourth quarter of 21, the data clearly changed amid waves of new COVID-19 variants, with only gradual process in restoring global supply chains and relatively few workers rejoining the labor force. That lack of progress, combined with very strong demand from households, contributed to a tight economy and a historically tight labor market and more persistent high inflation. The committee signaled a change in our policy approach and financial conditions began to tighten. Of course, a new shock arrived in February of 22 when Russia invaded Ukraine, driving up prices of energy and other commodity prices. By the time we lifted off in March, it was clear that bringing down inflation would depend both on the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allow supply time to catch up. Today, these two processes are working together to bring inflation down. The FOMC has raised the federal funds rate target by 5.25 percentage points, and we've reduced our securities holdings by more than $1 trillion. Monetary policy is in restrictive territory and putting downward pressure on demand and inflation. The unwinding of pandemic-related supply and demand distortions is playing an important role in the decline in inflation. For example, wage growth has steadily fallen since mid-2022 by most measures, despite continued robust job gains, reflecting a resurgence in labor supply, thanks both to higher labor force participation and a return of immigration to pre-pandemic levels. While the broader supply recovery continues, it's not clear how much more will be achieved by additional supply-side improvements. Going forward, it may be that a greater share of the progress in reducing inflation will have to come from tight monetary policy, restraining the growth of aggregate demand. Turning then to my second question. For many years, it has generally been thought that monetary policy should limit its response to or look through supply shocks to the extent that they are expected to be temporary and idiosyncratic. Many argue as well that in the future, supply disruptions are likely to be more frequent or more persistent than in the decades just before the pandemic. A second question then is what we've learned about this standard looking through approach. The idea that the response to the inflationary effects of supply shocks should be attenuated arises in part from the trade-off presented by those shocks. Supply shocks tend to move prices and employment in opposite directions, whereas monetary policy pushes each in the same direction. Therefore, the response of monetary policy to higher prices stemming from an adverse supply shock should be attenuated because it would otherwise amplify the unwanted decline in employment. In addition, supply shocks have most frequently come from the volatile food and energy categories, and they've passed through quickly. While food and energy prices critically affect the budgets of households and businesses, the policy tools of central banks work more slowly than commodity markets move. So responding aggressively to quickly passing price increases could exacerbate macroeconomic volatility without supporting price stability. Our experience since 2020 highlights some limits of this thinking. To begin with, it can be challenging to disentangle supply shocks from demand shocks in real time, and also to determine how long either will persist, particularly in the extraordinary circumstances of the past 3 years. Supply shocks that have a persistent effect on potential output could call for restrictive policy to better align aggregate demand with the suppressed level of aggregate supply. The sequence of shocks to global supply chains experienced from 2020 to 22 suppressed output for a considerable time and actually may have persistently altered global supply dynamics. Such a sequence calls on policymakers to use policy restraint to limit inflationary effects. Policy restraint in this case is also good risk management. Supply shocks that drive inflation high enough for long enough can affect the longer-term inflation expectations of households and businesses. Monetary policy must forthrightly address any risks of a potential de-anchoring of inflation expectations, as well-anchored expectations help bring inflation back to our target. The sharp policy tightening during 2022 likely contributed to keeping inflation expectations well anchored. My third question, then, is the level where interest rates will settle once the effects of the pandemic are truly behind us. By 2019, the general level of nominal interest rates had declined steadily over several decades. As the pandemic arrived, many advanced economies had below-target inflation and low or mildly negative rates, raising difficult questions about the efficacy of interest rate policy when constrained by the effective lower bound, or the ELB, as we call it. Over 2 decades, an extensive literature had identified a number of possible changes to the widely used inflation targeting regime, including negative policy rates, nominal income targeting, and various forms of makeup strategies, under which persistent shortfalls in inflation would be followed by a period of inflation running moderately above 2%. Today, inflation and policy rates are elevated, and the effective lower bound is not currently relevant for our policy decisions. But it's far too soon to say whether the monetary policy challenges of the ELB will ultimately turn out to be a thing of the past. The The prolonged proximity of interest rates to the ELB was at the heart of the monetary policy review and the changes we made to our framework in 2020. We will begin our next 5-year review in the latter half of 2024 and announce the results about a year later. Among the questions we will consider is the degree to which the structural features of the economy that led to low interest rates in the pre-pandemic period will persist. With time, we will continue to learn from the experience of the past few years and what implications it may hold for monetary policy. These are just 3 of the many questions raised by these challenging times, and of course, we're very far from a complete understanding of the answers. Again, it's great to be here today, and I look forward to our conversation. Thank you.
Thank you. Thank you.
Jerome Powell, the chair of the Federal Reserve, delivering remarks as part of the IMF's annual research conference taking place today down in Washington there. Pretty much straightforward here, where he talked about the idea of the difficulty of getting back to that 2% target, the idea that the Fed has a lot more work in order to do that, but in his words, they do plan to stay the course. Still with us is Michael McKee, our international economics and policy correspondent. And Mike, give us a sense here. I mean, this obviously didn't veer too far away from some other comments that we've heard out of him. Did it veer too far away from comments that we've heard from other FOMC members?
No, everybody's pretty much giving the same message at this point, that they think they're done. I mean, you have to read between the lines to get that message, but they think they're done, but they're not going to, at this point, write off the idea of additional rate increases because they're right in the middle here. They don't know for sure that inflation is going to continue to come down, and they don't know for sure that the economy is going to slow down as it's indicated, or that unemployment won't continue going up. They need some more data on that. They need to watch for a while longer. So they're all kind of saying the same things. Powell is, you could look at this as sort of a cut and paste of things that he has said in the past, but the emphasis changed a little bit. I was thinking earlier, Romaine, that it's a bit like a Grateful Dead concert where they play the same songs and the same lyrics, but they change the music each time to give it a little bit different emphasis. And this time the emphasis was...
I just want them to play the classics the way we know the classics. How do you think Powell feels? Isn't he a deadhead too?
He is a deadhead, so maybe he took a lesson from them. But you know, the bottom line basically is to go back to a really old saying. Powell at least drained some of the punch out of the bowl.
Yeah. Bloomberg's Mike McKee, appreciate you sticking by, and I'm sure Jerome Powell would be thrilled by the comparison. Let's go now to Diane Swonk, still with us, of course, chief economist over at KPMG. And like Mike said, I mean, it's a lot of what we've heard already, but to go through some of the specifics, I mean, Powell warned about basically being tricked by inflation head fakes. And what would a head fake look like to your view, and how real is that possibility right now?
Well, I think this certainly is the issue, is how much inflation has come down. If all of a sudden they know that we're going to see a change in the way inflation is measured in October, especially in medical insurance, that is going to add to inflation. They already know that. If there's something above and beyond that and they get surprised on the upside in inflation, they'll be worried that the deceleration we've seen was maybe more due to some seasonal factors and not as much due to fundamental cooling of inflation. I think something else he said was really important, and that was when he talked about looking through supply shocks, and that we are likely to have more supply shocks in the future, although he wouldn't commit to what he thought the neutral rate would eventually be, because they're going to do that reassessment in 2024 into 2025 in terms of how they think about what their policy decisions will be. I think that talking about that you no longer can just look through supply shocks as if they're transitory is really important, because that is what central banks around the world are saying. It's what Christine Lagarde is saying, what she said at Jackson Hole. And you're starting to get this sort of commonality of the fact that there may be that higher neutral rate going forward.
Yeah, and to the point, when it comes to those supply shocks, you can look through them until you can't, of course. Maybe we learned that lesson a few times. But bring this conversation into where we sit when it comes to the labor market, of course. We've gotten more reports, maybe some cracks starting to form, maybe some noise as well. When you think about this higher for longer environment that Jerome Powell, again, seems to be reiterating we're heading into, when does that start to cause more widespread cracking?
Well, what we've got right now is, the month of October got exacerbated by strikes, which have now been resolved, and the survey for November is next week. So that's good news for November. That should help to buoy employment gains. But what I see is where the cracks are, and it was interesting to hear where Chairman Powell is worried that labor supply may not be as plentiful as we've seen so far, because we had some catch up in immigration, and we saw an increase in participation that may be limited going forward. So he's worried about pressure still in there. But we've seen almost over 90% of all employment gains since July have been concentrated in just three sectors: leisure and hospitality, healthcare, and mostly public education, government. Those three sectors are the least interest rate sensitive sectors. That's a much more narrow gains in employment than we've seen. And it makes us more susceptible to things like strikes and the collateral damage of that. The ranks of the unemployed over the summer increased because there was more people looking for work, not because we had a surge in layoffs. In October, there was also people displaced, having to take more part-time work because they did not have full-time work due to work stoppages and because they were laid off. And I think that's important to sort of keep in mind, is where do those things fall out as we move forward, but that we're more susceptible to an external shock. The other issue is, he talked about how strong the economy is. The strength of the consumer accounted for over half of growth over the summer. And it was not that strength could lead to more inflation.
Yeah, and it'll be interesting to see, particularly as we head into the holiday season, where, of course, a lot of us tend to spend more than we would during the other months. I am curious, though, one thing you were kind of touching on there, too, with regards to the job market. And in that latest job report, to see more people coming back into the labor force, which I guess is a good thing. But there was a lot of some economists making some hay over the idea here that it doesn't appear that a lot of those people coming back into the labor force, at least based on the aggregate data, are actually finding jobs.
Well, and that's why the unemployment rate's gone up. And so they are finding jobs, but not as rapidly as they did. Hiring is not as strong as it was. Demand in the labor market has cooled, even though the job opening and labor turnover survey showed that it actually increased in the month of, by the end of September. We know that the high frequency job indexes, it's still well above February 2020 levels. The labor market is still healthy. But there are some reasons to believe that, we are more narrowly focused in where we're getting the job gains, and that does make us more vulnerable. And so the question is, do we have a resurgence now that we're getting past these big strikes, and job growth picks up again and unemployment comes off a bit? Or are we going to have a continued rise in unemployment as the corporate sector continues to be more constrained than consumer, and they actually do some layoffs or don't do hiring, certainly not as much hiring as they have been? How did we get an acceleration in growth like we did? We were able to do more with the hires we had, and we had a lot of productivity. That's good for inflation, but it also means we're not hiring as much either. We don't have to hire as much going forward.
All right, great conversation, and so appreciative, Diane, of you taking time to stand by with us today and give us your insights. Diane Swonk there, she's the chief economist over at KPMG. And Katie, we talk about kind of what we heard out of Powell today, and we should point out, too, just for our viewers, that presentation is still going on. All the other panel members will give presentations, and then at some point, they're going to circle back around for a Q&A session, which we do plan to bring to you as soon as that occurs. But we got a taste kind of where Powell's mindset is here. And while it certainly wasn't a surprise, the idea that he keeps reiterating something and the market, to a certain extent, keeps trying to sort of find some other message in the meaning. It seems like we've been doing this now for, a year and a half?
Yeah, it definitely felt like a sort of clear the air sort of performance. And the fact that he is sticking to that message, even after markets moved like they did, tells you something, and you can see markets reacting to him. The S&P 500 did hit session lows, not huge losses, but down 0.6%. Meanwhile, you take a look at the bond market, yields absolutely spiking in response to that. You take a look at 10-year Treasury yields right now above 4.62%. We were below 4.5% coming into today. Yeah,
coming into today, we should point out some of that yield spike too was off of that 30-year auction, which was like, I don't know. Bad is probably the best way to describe it here, and it gets back to this idea here that Powell is now up against a lot of forces that are kind of outside the purview of just normal monetary policy, meaning the rate hiking and rate cutting mechanism, right? You're dealing with Treasury supply and fiscal policy issues, not to mention all the geopolitical issues that are still lingering out there. I mean, the Bank of Israel governor is speaking right now at that same panel, and he started off talking about, obviously, the war with Hamas right now and how that and the effect that it's having on the economy over there.
Absolutely. You have hot wars going on. You also have, think about what's happening in the energy complex. We've seen oil come down, but remember what we saw this summer and how high oil can go. Yeah, absolutely here. Let's continue this conversation here about what's been going on with regards to macro policy and some of the geopolitical issues here, particularly when it comes to inflation. Ken Griffin actually had a chance to sit down with us, and he's actually warning that geopolitical and the shifts towards deglobalization may actually lead to higher baseline inflation that could last for decades. Of course, he is the co-founder of Citadel, who knows a lot about this. He was speaking at the Bloomberg New Economy Forum in Singapore. Let's take a listen.
Regretfully, the peace dividend is clearly at the end of the road. No matter what one may dream to be reality, reality is there's two wars in the world right here, right now, one of which is in Europe. So there's no doubt that the NATO countries are going to have to increase defense budgets over the years ahead. That's going to come at a point in time where governments around the world are already struggling with the sizes of their deficits. And then when it comes to globalization, I mean, we're in Singapore. We are at one of the global nexus in the world of trade, of finance. Many of us in this room have been tremendous beneficiaries of globalization. And it hasn't been great for everybody, to be clear. But for the world as a whole, it's pulled 1 billion people out of poverty. But now we're talking about deglobalization. We're talking about re-architecting supply chains. And some of this is rooted in the behavior that we saw in the pandemic. We saw countries hoarding personal safety equipment. We saw the tension around the distribution of vaccines around the world. Countries are much more sensitive to what do we want to have created domestically so that we're not reliant upon global trade. And then take that into the general geopolitical trends right here, right now. The war in the Ukraine has resulted in Europe losing access to natural gas from Russia for all intents and purposes. Europe struggling to deal with how does it maintain its economy having lost its cheap source of energy. So there's many trends at play right now that are pushing us towards deglobalization. And with that is almost certainly a trend towards higher baseline inflation.
And the implications of higher inflation might be obvious to some, but I think we'd all like to hear it from Ken Griffin.
Well, it depends on where this baseline effect lands. If we're looking at a 2 or 3% baseline effect, in some sense, the central bank will have a much easier job in the United States. The struggle over the last 20 years has actually been to hit a 2% target. And there's a variety of reasons that you want a low level of background inflation. It helps to lubricate the wheels of commerce. And that number the Fed has committed to as being 2%, they're going to fight pretty hard to keep that as the target for a litany of good reasons. But it also means that we're likely to see higher real rates, and we're likely to see higher nominal rates, and that will have a real implication on the cost of funding our enormous deficit. The U.S. has $33 trillion of debt outstanding. We didn't plan for an era with higher nominal and higher real rates when we went on the spending spree that created a $33 trillion deficit.
Citadel founder and CEO Ken Griffin speaking at the Bloomberg New Economy Forum in Singapore. And while he was speaking, some breaking news back here in the U.S. Senator Joe Manchin of West Virginia says he won't seek re-election. Of course, he is the Democrat from West Virginia who quite frequently votes along with the Republican Party. Of course, he has been a bane in the side of both the Republicans and the Democrats from time to time. Of course, he just was re-elected, I think, back in the 2018 election, but now saying that once his 6-year term is up, he will not run for re-election, Katie.
Definitely a bit of a surprise here. Posting a video on X saying that to the West Virginians who have put their trust in me and fought side by side to make our state better, it has been an honor of my life to serve you. Thank you. So interesting. Yeah. He's also saying that he's accomplished what he set out to do for West Virginia, that according to his statement, but definitely a bit of a surprise there.
Yeah, definitely a bit of a surprise, given that he was kind of for at least a while, definitely over the last couple of years, really kind of the decider of a lot that went on in the Senate. It was basically if you had any sort of issue that was very partisan, and given the divisions that we have in the Senate right now, he often ended up being that decisive vote. Remember, as we sit right now, you have a Senate seat on 100 seats in the Senate, 48 of them now occupied by Democrats, 49 by Republicans, and the independents there that round that out, of course, caucus with the Democrats, which of course gives the Democrats now a very narrow majority. But it will be interesting to see what happens in that 2024 race with him out, who is going to step up and vie for that Senate seat, and whether it will remain in the hands of Democrats or whether it will flip to Republicans.
Yeah, and it'll be, of course, not just for the 2024 presidential race, but you think about all the work that Congress has to do. Of course, we've been focusing so much on the drama going on in the House, but the Senate, I remember those conversations we were having when we were watching Mike Johnson get elected, basically saying that the Senate is something you can rely on, that they're going to get things done, that what the Senate says the House will follow, and just you wonder who is going to fill that leadership vacuum.
Yeah, and I think we can go, yeah.
Well, I'm thrilled to say that joining us now to help make sense of what's happening, we have Bloomberg's Kayleigh Lines sitting down in Washington, racing to the set. And Kayleigh, Romaine and I are surprised. Is that your sense as well? Did we have any indication that Senator Joe Manchin wouldn't run for re-election?
Well, of course, there's been a lot of conversation here in Washington, really over the course of this entire presidential election cycle, as to whether or not this is someone, given that he is a Democrat who is often broken with the Democratic Party, and increasingly so in more recent history, if he was someone who could actually seek the presidency himself under perhaps the No Labels umbrella. No Labels, of course, an organization that has said if we are looking at a Biden-Trump matchup in 2024, that they would run a candidate. And there has been a lot of conversation about whether or not that ticket could possibly include Joe Manchin. It is unclear if this decision not to seek re-election in the Senate would be directly tied to 2024 or future presidential ambitions. What we know at this time is he said he has considered this deeply with his family. He thinks he has accomplished what he set out to do for West Virginia and is not running. We know he was facing a very tough challenger in the Republican governor of West Virginia, so he was in a tricky spot. But this puts Democrats in a very tricky spot more broadly, considering the Senate is very, very close in terms of the partisan breakup. There's a very small majority for the Democrats. They often have to rely on Vice President Kamala Harris to be a tiebreaker, and losing a Democratic seat potentially could go to a Republican in West Virginia that would hold that seat in the future, and that could potentially disrupt the balance.
Well, that's what I am curious about, and we should point out, I mean, Manchin is, I believe, 76 this year here, so there is an age factor, of course, an age factor as well for the current president and the current Republican frontrunner as well. But one thing I am curious about here, Kayleigh, is this idea that a lot of his public stances that Manchin made seem to be, and he's a Democrat, a lot of the decisions he made seem to veer a little bit more to the right, largely because of his constituency and the pressures that he was facing in West Virginia if he wanted to hold on to his seat. So it raises the question that if he had to do that, does that mean that whoever does end up replacing him will probably have to maybe move a little bit further to the right to ensure some sort of place in the Senate?
Yeah, that's a very good point, Romaine. He has frequently broken with the Democratic Party on a number of issues, energy being a dominant one, considering that West Virginia is a coal state, and he is, sided more so to the right on a lot of those issues in the recent past and pretty consistently throughout his tenure as a United States Senator. So again, it would probably need to be a more conservative leaning Democrat if a Democrat was going to try to get the seat in West Virginia, or ultimately it could be just a seat that goes to the Republican, given the broader leanings of that state in general electoral politics. West Virginia is considered a red state, which is why Joe Manchin often straddled the line and had been one of the more independent voices in the Senate. Of course, he, alongside now independent Senator Kyrsten Sinema of Arizona, had kind of been the Democrats who held out on a lot of what the Biden administration had tried to pursue, and kind of were not kingmakers for legislation in the Senate, but somewhat.
All right, Kelly Lyons, who co-hosts Balance of Power. Of course, they're going to have a lot more coverage of that on their show, which airs at 5 p.m. Washington time. The headline here is that Senator Joe Manchin, the Democrat from West Virginia, who took that seat back in 2010, will not seek re-election. That election is in 2024. This will end basically 3 terms for the senator, who has been a somewhat controversial figure for both his own party as well as the Republicans alike. And now, of course, the big battle for that seat will begin. Stick with us. A lot more coverage coming up here on The Close. This is Bloomberg.
All right, a lot of breaking news this past hour. Let's get to another developing story. The Industrial and Commercial Bank of China was hit by a cyber attack that prevented it from clearing swaths of trades, forcing clients to reroute transactions and leaving brokers and traders scrambling. Joining us now with more is Bloomberg News finance reporter Catherine Doherty. And obviously, this is a quickly evolving situation, but what do we know so far?
So far, the Treasury has come out and acknowledged that this was a ransomware attack and that they're looking into it, and that also ICBC is in contact with regulators that have weighed in. We have market participants. Some of them in the beginning of the day were saying that they were seeing liquidity impacted, which is why it was gaining more and more attention. But then others are coming back and saying that this is also a more isolated part of the Treasury market. So you are able to see trades settle elsewhere. This is not shutting down the entire market, but it is raising some red flags just whenever you have a ransomware attack like this. Yeah. And the regulators are once again stepping in, making sure that not only everything is going to be is settled by the end of the day, or at least resolved, but that this won't happen again, and it won't impact potentially an even larger player.
Won't happen again? But hasn't this happened in the past?
So this has happened in different markets. So we covered a ransomware attack that happened that affected the derivatives market. It was a company, a subsidiary of Ion, and they resolved that issue. But it was a time that really we saw the regulators come out. The CFTC said that they were going to look at some of their cyber regulatory restraints and rewrite some of the rules so that this wouldn't happen again. And but really, when you see this, it raises the red flags, the concerns, and you just try to make sure that everyone is in contact and resolving what they can on the day, and that by tomorrow, hopefully, this will be resolved.
So those efforts ongoing. Talk to us a little bit about how they're trying to resolve it. I see in your reporting, for example, that the bank has hired cybersecurity firm Mandy, the FBI stepping up to offer assistance. What's going on here? So
they're contacting all of their members, and not only that, market makers, the banks, anyone that is operating in this market is in constant communication. SIFMA held a call today, and it organized its members to both understand who may have been impacted that needs to contact another person within their membership, or just resolve some of the concerns that everyone is raising today, and some of the questions also that come up.
All right, and we should point out that ICBC has told clients, tried to reroute some of those trades here. The world's largest lender by assets right now still dealing with the fallout from that cyber attack. Catherine Doherty all over the story for us. We'll get you some more details on that as soon as we get them. But we do want to go back to the other breaking news coming out of Washington, Katie Greifeld, and that is the end of an era for Senator Joe Manchin. Of course, he was the Democrat from West Virginia, ascending to that Senate seat back in 2010. The 76-year-old saying that he won't stand for re-election next year when his term is set to expire in early 2025. And of course, this opens up some wild possibilities because we talk about a very narrow margin for the Democrats right now in the Senate, with 48 Democrats, 49 Republicans, and then those 3 independents, of course, caucusing with the Democrats, which gives them the power, at least for right now.
Absolutely. You think about what a blow this is to Democrats trying to keep that Senate majority. And you think about Republican trending West Virginia, who is potentially going to occupy that seat. A lot of questions. All right.
We'll dive into that. And of course, we have a lot of market coverage for you as well. Stick with us here. Romaine, Bostick, and Katie Greifeld. This is The Close on Bloomberg.
U.S. banks are doling out fewer loans to businesses as lending standards tighten and demand weaken, suggesting that economic growth could slow as credit contracts. Bloomberg News credit reporter Olivia Raimondi joins us now with the story. And talk us through those dynamics there. The fact that you both have standards tightening, but also demand is slowing. What's the bigger factor here?
Thank you for having me on. Yes, I think it's really coming from both areas, but the point where there's been more concern flagged to me from economists has been in the demand, because we're seeing less demand for inventories, for equipment spending, and that's the kind of forward-looking indicators that make economists think the economy is going to slow in the future.
Well, that's what I'm curious about, because we know it's coming from the demand side, but the question is it because businesses don't feel like they can get the terms and the rates that they want, or is this really about them looking at their own business and seeing a potential slowdown and saying, we don't need to borrow anymore right now because of it?
Yeah, I think that's like the million-dollar question,
Yeah.
and it's difficult to say, but I do think that it's because businesses are trying to shore up their balance sheets. I think there are companies that are coming to the market. We've seen strong issuance in investment grade and high yield bond issuance, but it's really like the leverage loan market where we're seeing that weakness, and that's because they're not able to access them.
But when you say shore up their balance sheets, though, I mean, that gets to the issue of whether they're spending on things like CapEx or expansion, or whether they need that money to actually refinance existing debt, outstanding debt.
Yes, so we've seen a reduction in buybacks, according to JP Morgan, 5% for companies that are borrowers in the U.S. market. We've also seen a drop in financing for M&A spending. So we are seeing that come in as well.
And Olivia, it's one of those stories about the credit market, which seems like a bad sign. And it just feels still like you have to squint to see distress in this market. You take a look at overall spreads, of course, a blunt measure of looking at things. But when do these stories start to snowball and actually manifest in a broader way?
I think that maybe we'll see that next year. Honestly, people thought we were going to see that this year, and it hasn't happened yet. The market has been really strong, which is why I thought this story was so interesting, actually, because when you think about these long and variable lags that we're waiting to show up, we haven't really seen those. But this year in the lending is an example that we might be seeing more to come.
Olivia Raimondi here, a closer look here at, I guess, the lack of activity that we're seeing in that space here. But Katie, we need to go back to the broader markets. We haven't had a lot to talk about today because we were so consumed by Powell, and we are going to get back to Jay Powell once they go to that Q&A session down at the IMF here. But markets are really on the back foot now, hitting session lows. And of course, you talked about what we saw in the yield space, which is, once again, absolutely phenomenal.
Yeah, I mean, you think about that Treasury auction that we saw of longer dated debt. It tailed by 5 basis points, which seems like a lot.
Did that excite you when you saw it?
It did. That's a huge tail. I need to check the size and scope, but it really shows. It really put demand worries back into the Treasury market. You know, we were getting comfortable with this rally that had been building. Now a little bit of a snapback.
All right, let's keep an eye. The S&P 500 down about 0.8% here on the day, right around session lows, with almost 400 of the names in that index lower on the day. Your 10-year yield moving by 17 basis points right now. And oh, look at that. Bitcoin perking up here now, erasing all of the losses that it had back from that big crash a year ago. This is Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
Interesting day here in the markets. Katie, we started off with relatively modest losses in U.S. equities, but those losses now starting to accelerate as we get closer to the close.
Starting to snowball a little bit. The S&P 500 down about 0.8%. Of course, we're coming off the longest streak in I forget how many years. I think it was 7 straight days of gains all told, though. So
eight. Don't shortchange the S&P.
8 days of gains. So some important perspective to keep in mind there. But man, we are seeing that sell-off reignite in the bond market. 10-year yields now up 13, 14 basis points or so. I guess that's what happens when supply and demand worries reignite.
Yeah, believe it or not, healthcare actually one of the big drags on the market today. In fact, the biggest percent decliner in that space in the S&P 500 is Becton Dickinson today here, and that's down about 9% on the back of some earnings here. And then you saw Bitcoin up there. Remember we used to always talk about Bitcoin? And now?
Looks like we're going to do it now, though.
Yeah, I think we still have a crypto show. So they do talk about it pretty frequently here. But at one point on the day, you actually did see Bitcoin back above that 37,000 level. 18 months since that, what was it, the Terra crash, right? They they basically recouped all of the losses from that, but still a far cry from the highs.
And not to spend too much time on crypto, but Ether also having a fantastic day.
Yeah.
There's some speculation
That was a great song.
that maybe some of these big issuers are going to file for spot Ether ETFs. Let's see if we can get through a spot Bitcoin ETF first.
One other interesting thing, too, and you guys can flip up the board here, because we talk about this idea here of earnings season and what it's provided here. But there are a lot of people that have talked about this idea that while earnings have held up and that earnings recession is certainly long gone, but the idea is you're still not seeing the same degree of value. The idea is that things are still expensive on a relative basis. And then when you overlay that with the type of returns you can get in relatively risk-free markets, and then this chart you're looking at here, which is U.S. GDP growth outstripping earnings growth. And I have to give a hat tip to Savita Subramanian, who kind of pointed this out in an interview and in a note here about earnings have really lagging now for 5 straight quarters of the GDP growth, which is something you typically don't see happen. Usually it's kind of the other way around, kind of earnings, and usually end up being a nice preview of what you're going to get out of GDP here. But right now, you don't really have a really healthy earnings market right now, at least as a reflection of the entire economy.
And you think about some of the biggest rewards you're seeing in the stock market, it's the companies that are cutting costs, et cetera, versus than actually growing, which again really speaks to the environment that we're in. But let's get to some of those individual movers right now. I wanted to talk about Tesla. Tesla is just having a terrible day right now. You can see it's down 6.5%. That's on track to be its worst day in about a month or so. And the reason why, I'm not really sure if there is a fundamental reason, but of course, matters at a benchmark level.
Well, I wonder if this is tied to some of the results that we heard out of Rivian, out of Lucid, where you really are seeing a softness in demand overall for EVs. It's just you had the early adopters. They either have their cars already or they're on their way. But for those other folks that were maybe kind of on the fence, you know, with interest rates where they are and the cost of these vehicles still relatively high, you know, you're just not seeing the same demand.
Yeah, and of course, that's a long-standing problem for Tesla. You think about all those price cuts that they've put through trying to juice demand. Definitely a lot of different headwinds.
Do you have one of these Lucids? Because they're expensive.
I don't have a Lucid.
Yeah, they're like over 100 grand for just like a base model.
Yeah, you have to really love cars, really believe in EVs to want to pony up that amount of cash. But let's move on here. Let's talk about Disney, because this is an earnings story. And you think about the rally that we're seeing in Disney today, up almost 7%. You broke these earnings live last night. And this gets back to what we were just talking about. You think about the $2 billion that they're looking to put through in cost cuts. That's clearly getting rewarded today. Yeah, it's getting rewarded here. And it's funny, as you speak about this, I mean, there's been a lot of talk about the streaming service. Obviously, they're sort of contractually obligated to buy Hulu, and Bob Iger talked about how they're going to now start beta testing kind of that mashup between Hulu and Disney+. But while you were speaking, the Wall Street Journal actually coming out with a headline saying that Netflix and Warner Brothers Discovery are going to join with Verizon to offer a discounted bundle. So we've gone from the cable TV bundle era to the streaming era, which was a golden era, right? You know, $6 a month or whatever it was back in the day when it started, and you get all this content. And now, Katie Greifeld, we're back to bundles again. Time is a flat circle. What a joy that is. And
$10 a month combined is what the Wall Street Journal is reporting. Are you going to pay that?
Probably not. I don't know. I just watch things on
Okay,
YouTube.
So no EV for you and no bundles for you. What else you got?
No, I just drive my gas car and I just watch things on the internet. But let's also talk about Eli Lilly, of course. This was big news from yesterday, them getting the FDA nod basically for their weight loss drug. Shares, of course, surged, as we saw. They hit a record high yesterday. You're seeing some of that enthusiasm come out right now. Eli Lilly shares down about 5% or so. So maybe people taking profit here, maybe a sell the news sort of event. Of course, this is one of those companies that has just had a stellar 2023.
Yeah, absolutely. Here, let's talk about the broader markets here as we count you down to the closing bells. We're just about 55 minutes away until we get there, and all the talk today, it's not actually in the equity market. It's much more in the fixed income space. So who better to talk to than Tony Rodriguez, the head of fixed income strategy over at Nuveen. Tony, welcome back to the program here. Let's just start off here on the meme stock trade that has now become the Treasury market here. We're looking at 16 basis points higher on the 30-year, 13 basis points right now on the 10-year, and really the volatility in between that has gotten us there has become kind of the norm over the last year.
Well, good afternoon, Romaine. Good to be with you. You're right. Now, 10 basis point days in the Treasury market seem to be, a snooze. It happens all the time. And what's interesting about today's move is that really it's a little bit of a mirror image in part from what we saw last week. Well, last week we saw a refunding announcement that kind of positively surprised. We saw a Fed that was interpreted as being dovish, and that helped to really drive yields lower. We sit here today, and of course, you get an auction that was very poorly received, big tail, so very weak demand. And you saw Powell trying to, I think, offset some of the interpretation of that more dovish press conference from last week with some hawkish statements saying not sure they're done and certainly ready to tighten if, in fact, they need to. So you get a little bit of reversal here in rates. At the end of the day, we kind of think fair value is around 4 3/4 on the 10-year. We're a bit below that right now, but we think we'll be range bound for the next 3 to 6 months until kind of the trajectory of the economy and inflation becomes a bit more clear.
Well, then what do you make then? I mean, there's been a lot of discussion today about term premiums and about the yield that folks are going to demand, particularly for new issues. And we saw that, of course, with the 30-year auction today here. What is the threshold that you look at here that where you do think investors will get more comfortable taking on Treasury supply?
Yeah, I think what we're going to need to see is a little bit more evidence that the slowing in the economy is in fact going to continue. So one employment report, which took the labor market from red hot to just solid, is not enough for that. So we're going to need to see some follow through on the employment market where jobs maybe are below 150,000 per month. That takes some of the pressure off of wages. And we're going to need to continue to see inflation data that is moving in the direction of the Fed. It's going to be a much slower move down from here over the next 12 months than what we saw over the last 12 months. But investors are going to have to get more confident in those fundamental factors in order to get comfortable taking down longer end supply in that 4.5% to 5% range.
And so that's the picture in the U.S. Treasury market. Let's bring that logic over to the corporate credit market. When you think about the fundamentals of corporate America right now, do you think that that's a worthwhile place to be? Or do you say, let's cut the credit risk out altogether and maybe lean more heavily into the Treasury market right now?
Sure. Hi, Katie. Good to be with you as well. So we are comfortable taking corporate credit risk to a point. Our view is that since you are going to see some slower growth in the economy in the next couple of months, you don't want to be in what we would call kind of the deepest end of the credit risk pool. So when you think about that, you're thinking about below investment grade credit, leveraged loans, high yield, emerging markets, preferred, CLOs, you name it. We like to focus there in the high end of that market. So double B credit quality, maybe high single B credit quality. We think you can find a lot of companies there that are going to be able to withstand a slowdown in the economy, deliver an 8.5% to 9.5% return to the investor, and you don't take on the more substantial credit risk of low single B, triple C paper, which those are the companies that we think are going to have a harder time handling kind of 1 to 1.5% GDP growth, given the level of debt they have and the higher cost of interest expense that they're all dealing with here.
And Tony, let's talk about this from a sector perspective. We talk about sectors all the time when it comes to the equity market. We don't do it too much when it comes to the bond market. I want to talk about tech specifically, because at least in the equity market, the narrative is that tech has sort of become this safe haven. You think about these mega caps with these fortress balance sheets going to make money for some of the big names in almost any environment. Does that argument hold water when it comes to the credit market, or how are you thinking about the different industry groups at this juncture?
Sure. So the thing that we are really most probably concerned about is the more deep cyclical side of the market. There, because of the slowdown we're expecting, we think those companies are going to have a much harder time given declines we expect to see in revenue, and given, again, interest expense is going to be high, cost bases that are going to have a hard time, delivering a lot of, for example, cost savings in that kind of environment. So we'd rather have more stable industries. Tech is an interesting one because it has components of both. So where you have a tech company that has high margins and has some pretty, strong market position, whether that's in the cloud or whether that's with the consumer, those companies you think will be fairly resilient. Financials are another example where there's clearly quite a bit of cyclicality there. But in terms of the kind of the larger, higher quality financial institutions, think about the global, systemically important financial institutions, there we're pretty comfortable both with their balance sheet strength, their asset quality, and their earnings diversification. So those are places that we think, sectors that we think will do well in the fixed income space.
I'm curious, Tony, as to how investors should factor in, I guess, some of the less tangible issues going on kind of on the periphery of the market. Obviously, we talk a lot about geopolitics and just our own internal politics down in Congress. But there's also a big regulatory wave out there. A lot of proposals coming out of Washington that are disproportionate, I think, to what the market saw, at least during the previous presidential term here. And I'm wondering when or if investors need to start paying attention to that.
Well, it's interesting with the regulatory story. I mean, it's the story really is that Washington's going to have a very hard time coalescing really around any kind of, I think, substantial legislative and regulatory responses, given the division that exists in Washington. So I don't think that that's going to be a significant problem. But at the end of the day, when you think about whether it's dysfunction in Washington or geopolitical risks, all of those are ones that certainly require a higher risk premium for investors, whether that's in the equity market or in the fixed income market. And when you think about all of those risks, we are operating in a world right now that has just about as many as I can recall that are potential kind of landmines as we move forward into 2024.
All right, Tony, great to catch up with you. Tony Rodriguez there. He's the head of fixed income strategy over at Nuveen, helping us count you down to the close. Just about 50 minutes until we get to those bells, with stocks on the back foot here and seeing a pretty severe sell-off going on right now in the Treasury market, with yields spiking across the curve, including up right now about 15 basis points on the longer end on your 20 and 30-year yield. Now, some of that spike was on the back of the latest Treasury auction, and some of that was on the back of some comments that we're getting out of Jay Powell. Jerome Powell speaking at an IMF event in Washington. We got his opening remarks a little bit earlier. We're still waiting, still standing by for a question and answer session, and we will bring you that as soon as we get to them. Michael McKee is standing by with us. He's our international economics and policy correspondent for us here at Bloomberg Television. And Mike, we talk about this idea here of inflation expectations and how far the Fed has gotten inflation back down, or inflation's come down, whether the Fed themselves got it down. I guess we can debate that here. But it raises a question here as to sort of how much wiggle room does the Fed have right now to be patient? You talked to Raphael Bostick last week, and he talked about this idea that they have somewhat of a luxury, right, given economic conditions, to kind of wait and see.
Well, even Neil Kashkari, who was one of the bigger hawks, is saying they have some time to watch. We're going to get CPI next week, and it's expected to drop, at least on a headline basis, to 3.1%, which is just above the twos where the Fed is looking for it to go. And if that happens, and if we continue to see inflation fall, then they won't have a reason to raise rates. But they don't know that that's necessarily going to happen. Obviously, there's a lot of geopolitical stuff out there, and we can't be certain that there won't be any supply chain interruptions and things that would push inflation up. But for right now, it looks pretty good.
Yeah, and don't mention the big budget deadline that is like a week from this Friday.
Well, we had Patrick Harker last night saying that could cut GDP by 1 percentage point. And that could lead to problems as well. So there's a lot to watch.
All right, Mike, stand by. We do want to go back to Washington with Jerome Powell. Let's listen in.
I think monetary policy is generally working in the ways that we think it should work, which is interest-sensitive spending, asset prices, exchange rate. I think there are some aspects of the U.S. economy where you can argue that it's a little different, and that would be, for example, households who are in low-rate mortgages are not selling their homes, but they're also not feeling the effects of higher rates because they really don't want to get out of those mortgages. Same thing with companies. Any company that had access to fixed-rate borrowing and didn't use that in the last 3 or 4 years would be facing. But there are very few companies that are in that. So it may be that the U.S. economy is structurally a little bit more resilient to interest rates. But I don't think that I don't see at this point anything that seems to be structurally or materially in the nature of a difference.
Amir. I sort of agree with Jay. I think the famous long lead, lags, it may be a bit longer. Partly people came out of COVID with a lot of savings. So the potency and the effect of monetary policy took longer, the adjustments of both supply and demand. But I think at least Israel also had, as I shown, a very strong recovery, and we are still above trend, but we're slowing down. So the effect of monetary policy was kicking in before this whole event. Inflation was probably on its way to our target in Q1 24. It just took, in my opinion, a little bit longer for these adjustments to happen. I also agree with Jay in his speech that the issue of supply, to look through supply, was there's a time to do that, but once inflation gets too high and too long, the expectation channel is so important. And as long as that was anchored in monetary policy, ultimately would kick in. It did take a little bit longer.
Okay, Jay.
I just want to, for a second, go back to something that Ken talked about, which is central bank independence. Unsurprisingly, I'm a believer in central bank independence. But it really is just an institutional arrangement that exists because the elected government allows it to exist, and as long as it serves the public well, it's a fine institutional arrangement. And I think it's easy to forget that we have this precious independence. It should be very, very rare in a functioning democracy that you have an institution that has the degree of independence that we have. Of course, we strive all the time to be democratically accountable and transparent. But I think that the temptation to wander into exciting new issues that really are the business of the elected government is a strong one and is to be resisted. And because I think that's, when I think of ways that independence could be undermined, to me, that's right at the top of the list.
Very good. Any other reactions or comments?
Well, I would just add to what Jay just said. I mean, I think many economists, particularly over the last 15 or 20 years, just take it for granted, and they have these very sterile technocratic models and don't realize that central bank independence is something central bankers have to fight for every day. I mean, it's a very political environment with which they have to protect their right to do monetary policy independently.
Very good. So let me open it up to the floor. So I'm going to start with Martin here. Please state your name and your affiliation, and then I'll move back and we'll alternate. So Martin, you go first.
So Martin Stürmer with the research department here at the IMF. Governor Yaron, thank you so much for joining us during these terrible times. I hope that you can live in peace very soon. Now, what are the scenarios that you are preparing for? What are the worst case scenarios that you're thinking about?
The projections that we gave, as I mentioned, were contained to a situation where most of the war is really at the southern border. It takes until the end of 2023. It doesn't mean there's no interactions in the war in the north, but there isn't a full-fledged transition into a war there. That's a different ball game. It will have a different impact. There's enough uncertainties even around just the issues of the southern border, just dealing with the southern border, how comfortable people will be coming back to some of the activities around there. The north border will be, if that happens, and we all hope that doesn't happen, this could have a much bigger implication. Is just a different scenario altogether.
Thank you. I'm going to go to the back, the lady over there. It should be working.
Hi, I'm Vivian. I'm an economist here at the IMF. My question would be to Mr. Powell. I wanted to hear your thoughts on a subject that Gita touched upon, which is the recent movements in the yield curve in these last many weeks. And I wanted to know if you think it's a change in natural rates, so maybe Fed funds rates should be a bit higher, or this is just a steeper yield curve, like higher term premiums, so maybe Fed funds rates could be lower. And also, I would like to, I'm a bit worried about over-tightening on a personal level, of course. So what would be clear evidence for you that rates are in restrictive territory enough, given the lags? I mean, we could be over-tightening. That's it.
Thank you. So on your first question, on the implications of higher rates, it's when we move the federal funds rate around, the real point is to affect broader financial conditions, and broader financial conditions then affect the economy, the real economy, in ways that we broadly understand. But so we don't target any one financial condition. We look at broader financial conditions. So it's very hard to draw a direct line from one particular thing like higher bond yields to what monetary policy should do. So the first thing you would look at, though, is you'd look for persistent changes. Even then, and so then the question is, and Gita touched on this appropriately, which is why are longer run rates going up? And it really, the reason they're going up really matters, so we have to factor that in. So it's something we're looking at. We're certainly not going to ignore a significant tightening in financial conditions through that channel, but we don't have to decide. We're moving carefully now. We've moved very fast, and rates are now restrictive, and so we're going to be looking at this question, and not something we're trying to make a decision on right now. In terms of I take your question to be why are long rates higher? I think there are many candidate explanations. And 5 or 6 of them, it's easy to get to a half dozen explanations. I think we really don't know. I think one thing to point out, though, is people are experiencing these higher rates are actually affecting people's mortgages. The costs of all their floating rate debt is being affected. So it's having an effect on the economy. You know that the standard thinking has been that this was largely about term premium. Then the question is, why term premium? I don't want to try to dive into all of that today, but it's something we're looking at carefully and just seeing. In terms of you mentioned over tightening, but how are we thinking? So I would just go back at the beginning. Really, the question was to move as fast as we could. As I went through with the chronology, in early 2022, it became obvious that we needed to tighten policy as quickly as we could. And also at a reasonable pace. So we did, and that was the main thing, was speed. The second question was going to be how high to go, and we're still on that question. We're still on the question of a policy stance that's sufficiently restrictive to bring inflation down to 2% over time. The next question will be how long to keep rates restrictive. And so we're looking at, there is no magic to it. We're looking at the incoming data, of course, but really we're looking at the implications for the outlook. It's really what are we learning about the outlook, the balance of risks, and all those things. And we're trying to make a judgment at this point whether we need to do more. And as I said, we did move very quickly. The speed is no longer, the main thing. The main thing now is to try to get to that right level. Of course, we don't want to go too far, but at the same time, we know the biggest mistake we could make would be to fail to get inflation under control. So that's not going to happen. We will keep at this until we succeed. So moving carefully and looking at all the evidence and trying to make smart decisions on behalf of the public.
Let's go in the front here, sir.
Thank you. I'm Charlie Kimball with the Korea Center for International Finance. Both in the United States and presumably in Israel, in 2020, fiscal policy and monetary policy were in line. And now they seem to be at cross purposes. That is, we have very easy fiscal policy here and presumably in Israel. Does that mean that the real rate of interest that you should aim for should be a little higher?
Amir,
do you want to go first?
I think this situation, I'm not sure we're in different situation right now in the U.S. So I think the job of the government in this kind of an emergency war situation is to supply the needs of many of the people who've gotten hurt from the war, and to try to minimize as much the damage that might be from this event, and that require fiscal spending. There's also, obviously, as Ken mentioned, there's likely to be more military spending over time. And the point that I was alluding to was that we need to find the right balance where, on the one hand, these spending be done, and at the same time go and very carefully find less needed, or especially given the circumstances, items in the budget, and direct them into those spending avenues, such that the fiscal stand over time, and we've demonstrated very responsible fiscal position. And I believe that if we do that, while the debt to GDP of Israel will go up for a while, the fiscal position will retrieve back and fundamentally can avoid structurally changing. But that require to do these appropriate adjustments over time that I mentioned.
So, first, the thing to say is that we stay very far away from commenting on fiscal policy, even indirectly. So, I won't do that. But I will say the way I'm thinking about this is let's look at where real rates are. So the federal funds rate's at 5.3 and change. If you take a 1 year forward look at inflation, maybe that's 3. So you've got real rates that are above 2%, and that's well above most mainstream estimates of where the neutral rate might be. I think that our star is as a not a particularly useful way to think about policy, because it can be affected by so many things, and it changes over the short run and the long run. So I think I tend to look at it that we're in the range, we're in the place where we have restrictive policy, and probably significantly restrictive policy, and we're watching the effect carefully on the economy. I think the question of, has the neutral rate risen or will it rise, and will that be because of this factor or that factor, is less interesting given the policy job that we have to do. Of course, we have all the models and we look at them and things like that, but really I think about it in a more practical way.
Final question, sir.
Dr. Mamadouba from Howard University and Athletic International University in Hawaii. Actually, the biggest problem in the world economy is inflation. Why the Fed did not change its fundamental goal from unemployment to inflation? If you understand.
I'm sorry, could you repeat that?
Yes, actually the fundamental goal, the biggest problem in the world economy is inflation. Why the Fed, your bank, did not change its fundamental goal from unemployment to inflation like the ECB?
Great, thank you. So we have a congressionally set mandate of maximum employment and price stability, and those two goals are equal under the law, and we can't change them. Only Congress can do that. We do have a provision. The question is, what if we're very far from one of those goals and not so far from the other? And what we do is when we say this in our constitutional document that we've written, it's not a matter of law, but our policy would be to focus on the one where we're farther away from the actual goal. So 2% inflation, we were a year or so ago very far from 2% inflation, and that has been our focus. As inflation comes back down, it becomes more of an equal weighting thing. And when you're equally far away from each goal, then the two are equal, because they are exactly equal under the law.
Thank you. So I want to thank our panelists, but I would like to give a chance to Ken to maybe have...
And we were just listening there to Jerome Powell, the chair of the Federal Reserve, speaking at an IMF event down in Washington alongside one of his counterparts from Israel, and Gita Gopinath, of course, who one of the managing directors there at the IMF here. A wide-ranging conversation that started off with prepared remarks by the Fed chief, who reiterated the need and more importantly, the will to continue on with keeping rates restrictive in order to get inflation back down to that 2% target. Jennifer Lee joining us right now to talk a little bit more about what we're seeing. She's a senior economist over at BMO Capital Markets. And Jennifer, certainly not a surprise that he would double down or triple down or maybe quadruple down on this narrative that he's really been trying to tell the market here. Not so much about rate hikes or rate cuts, but about the idea of restrictive policy. And that restrictive policy will remain there until he sees some meaningful progress back down to 2%.
Yes, thanks very much for having me on, by the way. I fully agree. This is a narrative, I think, that has been, taken by all the major central banks around the world, and certainly the Fed is no exception. By the way, I'm going to say this. I'm going to give him an A, a grade of A for clarity for his opening remarks. I mean, I think that's all. Just look at the bond market, what it did as soon as the remarks were released. Super clear what he said, that, that we still have a long way to go, that if things don't progress as they want, then they can warrant a response, and that we will not hesitate to do so. I actually don't remember, and sometimes my memory can be fuzzy, but I don't remember him ever really saying too often that the phrase that we will not hesitate to do so. If he did, maybe it was a while ago, but it's something that's back into the vocabulary again. So as you said, he's very much focused on getting the market's mindset back into the concept of restrictive territory and staying in that territory for some time.
And so, Jennifer, if the opening remarks were an A, how would you grade his performance at the most recent Fed meeting where he made those comments about how maybe the market was doing the Fed's work for them? And of course, that kind of backfired and you saw financial conditions actually loosen in the aftermath.
If today was an A, I'm going to give him like an E- or B++, if that's the case. I think he definitely did not like what he saw over the last week or so. Of course, it helped when we had some weaker data. That softer than expected payrolls report didn't help his case, the case much. And it's almost like a double-edged sword, right? You want to see the slower data, or softer data, you want to see the slowdown of the economy. But that, of course, means that the Fed will become potentially less restrictive, and then you see bonds rally, and then that's not exactly helping the Fed's cause. So clearly, they are not seeing enough. They're not seeing enough of a slowdown. And they don't want to be seeing any more head fakes either. They're going to have to look through that as well. And so again, this is the whole, I'm going to borrow from the ECB here, they're probably going to keep rates sufficiently high for a sufficiently long period of time in order to get inflation back down to 2%.
Okay, so I think between an A and a B, it still averages out to like a B+, which is pretty good. Let's see what else Powell had to say. Looking through some of the headlines, he reiterated that the, quote, biggest mistake would be to not do enough to bring inflation back under control. And he also said that's not going to happen. We're going to keep at this until we succeed. But from where you're sitting at this juncture, what do you think the bigger policy mistake or the risk would be for a policy mistake at this point? Would it be not doing enough or doing too much here?
I'm going to say right now it would be not doing enough. I think keeping rates at these levels, I think, is the right way to go right now. And of course, if we still see stubborn inflation, stubborn spending, then it might probably warrant another rate hike. But I think pulling back right now after all of this work, would be a very big mistake. By the way, I'm going to say I thought that this week was going to be kind of like a chill week, and obviously it hasn't been that case that way. And tomorrow's University of Michigan Consumer Sentiment Index, I think that's going to be a key one, because not only is it the preliminary figure for November, but everyone's going to be very focused on what happens with the 1 and the 5 year inflation expectations, because as you recall last time around, it had a pretty sizable jump. So we'll see whether or not that we see some sort of a downward revision tomorrow.
I am curious, and I mean, it's funny, you talk about how everybody's been on their toes, and I think there are a lot of people that thought we were going to have some quiet times, if you will, until the next Fed meeting. One interesting thing, though, that he did mention during the panel was the next big review of the Fed's framework. Of course, the last one came out in 2020, and it all talked about basically how to deal with persistently low inflation. And of course, we know what happened, of course, within a few months after that came out here. When that new review eventually does drop sometime next year, do you think we're going to get a little bit more forcefulness around whether A, they stick by a 2% inflation target, but B, whether the rate mechanism, rate hiking and rate cutting mechanism is a sufficient enough tool to do so?
I think it's going to be everything, all possible tools on the table. And again, I'm going to borrow from the ECB, who's actually been doing this right now. And, nothing is going to be held back. All possibilities are going to be thrown on the table. And yeah, I think that it's possible that they're going to look at other tools that could potentially be used in addition to the rate hikes. Although at the same time, this has not been a very typical time. We went through this pandemic, which, a pandemic like this no one has ever gone through before. And of course you saw the big drop in demand and then the big increase and then inflation and all the savings that everyone managed to gather up. So this is not exactly going to be like the typical event to model after. But I think certainly that this is going to keep all the policymakers at least open up their eyes and to the potential that is out there. And anything goes at this point, I think.
He also dodged a question about fiscal policy and some of the issues going on the other part of Washington there, and the idea that he doesn't necessarily want to get involved in that, and he tries to steer clear of that. But I mean, I don't think any market watcher thinks those two things are divorced right now. If we do end up with serious fiscal policy issues, whether it's an increase in the debt or the inability of Congress to actually pass a new budget, that has to have some ramifications for monetary policy.
It will, especially given that, we already had such strong growth, and we still do. And now we're still getting support on the fiscal side, and that's adding to the inflation problem. So this is definitely making the Fed's job a lot more difficult. At the same time, and we also have to remember, this is like, a lot of the CHIPS Act and the Inflation Reduction Act, a lot of this is like long-term issues as well, or long-term plans or goals, that are put in place. So when things go starting to slow a little bit, at least we're going to have that to lean on. So I don't think it's all for naught. Again, this is all like bigger picture issues in terms of these particular acts, just to secure the U.S. in terms of their supplies when certain things happen, like a pandemic.
All right, Jennifer, great to catch up with you, and really appreciate you standing by, listening in to the comments out of Jerome Powell a little bit earlier. Jennifer Lee, BMO Capital Markets senior economist. A lot more coverage coming up here on the big program as we count you down to the closing bells. This is Bloomberg.
Treasury Secretary Janet Yellen and China's economic czar are holding talks today in San Francisco as part of a two-day meeting. Now, Yellen said she'll address economic security tensions between the two countries, and Beijing, meanwhile, is accusing the U.S. of discrediting their business environment. Presidents Xi Jinping and Joe Biden are expected to hold their own meeting next week. And for more on what to expect, we're joined now by Bloomberg's long day, Enda Curran, joining us now from Washington. And under the umbrella of economic security, what would you expect some of the main topics at hand to be in this meeting between Janet Yellen and her Chinese counterpart?
I think it's more the significance that the meeting is happening at all, Katie, given where we were only a few months ago when communications were very minimal. Now the top two economic officials are getting together. The press releases say they're going to talk about areas where they can cooperate on the economy. So that could be climate change, for example, or look for cooperation on debt distress. That's the idea of helping poorer or emerging economies pay back the debt that they've borrowed during the pandemic and so on. So those are areas where there could be cooperation. But I don't think there's going to be any particular game changer per se when it comes to what they both can deliver. I mean, Ms. Yellen talks about it's not about decoupling, it's about de-risking. It's about this idea that the US will protect national security but will continue to do business with China. But of course, China doesn't really buy that argument. They push back that the US is trying to cut China off from the rest of the world, so to speak, and to contain its economic rise. So it's more, the significance is more to the fact that the meeting is happening at all rather than the outcomes, I think.
That is certainly significant, and of course the lead up to the face-to-face between Xi and Biden. But I mean, you mentioned this idea of the Chinese maybe being a little reticent about the U.S.'s ambitions and what they say to cut them off here. But Yellen has been pretty explicit that she wants to actually see some of those barriers come down, meaning for U.S. businesses having fair access, I should say, to the Chinese market.
Yeah, absolutely. Market access, protection of IP, protection of technologies, areas of national security. All of these points, Ms. Yellen has proven to be just as hawkish as others on. But she's trying to weave this line that the two economies can also continue to do business together. China, of course, pushes back on this idea. They are, though, given the slowdown in China's economy, given the real estate bust, and given the kind of negative sentiment on foreign investment in China, there is a view that China is kind of back on the market for some investment again, and that's partly why they do want to try and stabilise relations with the US as well, that it's also in their interest. They want to get better mood music, better optics, and try and get some global companies coming back into China. So there's a little bit of give and take on both sides here, but I would emphasise that it's relative to where we were. It's a big step forward, but in real terms, I think it's going to be fairly granular progress in terms of what does come out of these meetings.
Yeah, and just speaking to that granularity, when we do get to the big meeting between the two heads of states, I know that typically they're not the ones that get into that granularity here. But do you think just the optics of them meeting once again face to face could actually maybe further things along?
Yep. So, I mean, there's two ways of reading it. You can say last year, Presidents Xi and Xi met in Biden. That was meant to be the great reset. China-US relations back on track, or at least back on an even keel, say. But, of course, that was all shut down with the balloon only a few months later. And I think this time around, again, the story is one of yeah. And this time around, the story is one of just, again, stabilisation. The two leaders getting together in the room is clearly, progress in itself. But in terms of what kind of actual deliverables will come out of it, I think expectations are being managed on both sides. The best they can do is get the channels of communication open again, military to military, treasury to treasury, get those lines open, working again, and perhaps look for some areas where they can cooperate. But, of course, we all know with the US presidential election next year, the US-China story hasn't gone away.
Yeah, the balloon was back in February, Romaine. It feels like an actual lifetime ago.
I know. Is it still up there?
I don't know.
I mean, we shot it down or something, right?
Something like that.
Or we just let it drift back to China?
No, I
forgot all about the balloon.
I think it was shot down, but
there's just so much going on between the U.S. and China. It's hard to keep up.
There is a lot going on,
Yeah.
and we're talking about balloons, but let's also talk about chips because, like you said, maybe not many deliverables coming from this meeting, these series of meetings. But when you think about one of the big issues, one of the big topics of conversation, it really feels like the semiconductor industry is where a lot of these tensions are playing out.
The US continues to enforce export controls and other investment restrictions in what they consider to be sensitive areas of technology, semiconductors being the obvious one, but also AI and quantum computing are other areas. There's bipartisan support for that. China, of course, wants those restrictions lifted. They say you're just trying to tamp down our economic rise. There's no hint of a pullback by the US on that front. Broadly speaking, on trade policy, the Biden administration has been pretty hawkish, so no sign of a turn there.
All right, and they're going to have to leave it there. And Curran over at Bloomberg News in Washington. Stick with us. We're going to actually get back to markets and count you down to the close. This is Bloomberg. This is the countdown to the close. Romaine Bostick here, joined now by Scarlett Fu as we count you down to the closing bells and take you to the bell and beyond here. Let's talk about equities, but I want to start first off here, Scarlett, with what I think is the big number of the day, and it's at that 4.769% here. That was basically the tail that we got on that 30-year Treasury auction. And that was the widest gap that we saw based on what bidders finally took and what we actually saw in the market leading up to that. Showing that there's a lot less demand. That, of course, led to the big spike in yields that we saw on the back of that. And that seemed to have a direct feed through into the downdraft that we later saw in equities, which are now right around session lows.
Yeah, it definitely set the tone, didn't it? It was an ugly 30-year auction. That was a 1-2 punch of that, and then Powell sounding a fairly hawkish note. I don't know that he said anything different, but he didn't give any indication that there's any kind of rate cuts in the offing at any point.
He didn't say anything different, but I mean, you know this. The market wants him to say something, and that's the disappointment, right? It's like when he doesn't finally come out and say, "Yeah, finally we're cutting rates," which he's never going to say.
The same tune,
right?
And so everyone's disappointed.
And so they're always disappointed.
Yeah, and volume in the Nasdaq, by the way, is up 20% on the 20-day average. I always like to keep an eye on how things fare, especially on down days.
Yeah,
that downdraft is really encouraging a lot of activity.
And what does that tell you when volatility, or the volume, picks up on a down day? What does that tell you?
It just shows that people were positioned a certain way, perhaps.
Interesting moves here. And I mean, and we should point out, too, I mean, we're coming off of an 8-day run. I know some of those gains were modest, but still, that was a pretty good streak.
Yeah, but we're ending in pretty dramatic fashion as well. I mean, of course, the Fed giveth and the Fed taketh away. So.
Yeah, but I mean, look, what is it, 0.8% here? So, I mean, it's clawing back some of those gains, but I guess, these oscillations will continue. We'll see sort of what drives the market going forward and whether that remains the Fed or earnings or something else. Omar Aguilar joining us right now to help us count down to the closing bells. Schwab Asset Management Chief Executive Officer and Chief Investment Officer. And Omar, let's start off about, I guess, what is really driving the market. This really does seem to be still about what we're seeing in the Treasury market and, for that matter, what we're hearing out of Jerome Powell.
Yes, no, thanks for having me. And, we've been working on the thesis that for the last 18 months, the yield volatility that we see in fixed income has been driving a lot of what's going on in the rest of the markets. And, today was a perfect example where you saw those really big swings in yields, basically creating additional volatility in equity market. In fact, for some of the research that we have actually seen, 2/3 of the dispersion of equities can be linked to changes in bond yields. So that tells you a lot about the need for a little bit of a stability of yields to be able to just at least get a good sense of where the economy is, what the Fed might do, and potentially provide more countermeasures to risky assets.
I'm curious, though, that when you talk to clients and even just some of your peers out there about the volatility in this market, and I guess the fear that puts into the hearts of a lot of folks who are sort of waiting for that stability before they either make new entry points or maybe try to exit. But the idea here is that as long as that volatility cloud remains, you're just not going to have the same participation maybe that we had in the years past.
I think it's a combination of three things. One is there's clearly less liquidity in markets than it was, 2 years ago. So liquidity has been extracted by the markets, by participants, but also by central banks and for other market in participants in general. So liquidity is one source of volatility that continues to be there. The second one is you can actually have a case that the potential recession is still here. It hasn't gone away. The concepts of recession, when you see unemployment going up, when you see the yield curve is still being inverted, when you see that central banks, while on hold, they still have this hawkish tone, clearly gives you all indication that the potential of a recession is still with us. And then lastly, the uncertainty around the potential of missing the, a soft landing, which is the positive spin to this market, is also there. So when you combine all these three factors, clearly there is uncertainty, clearly there's hesitation by our clients, by other clients, and by other investors on when is the good time and how to diversify their portfolios.
Omar, are you at all interested in picking up any treasuries? I asked this on the heels of that disappointing 30-year auction.
Well, I think the disappointment of the auction today made it very clear that the demand for, even at these levels of yields, is not there. And I think what that does is, it has a combination of two things. One is that people clearly have, a view that normally when the Fed is closer to the end of their cycle, you actually see a rally in bonds. So what that means is that no matter what yield you try to lock in today, most likely that yield is going to come down here. So even in that perspective, which is probably the best yield you can get on a long time, if you believe the Fed is done, it's going to be very hard to actually get people to invest because of the uncertainty I just mentioned. So there's a clear uncertainty that if the Fed is not done, that there will be an additional yield that they can get down the road.
Okay, so that's how things stand when you're looking at duration. What about within equities? Given that everything is so predicated on the moves in bond yields, 2/3 of moves in equities, as you mentioned, tied to bond yields, how do you want to be positioned in equities? You want to steer clear of anything that has interest rate sensitivity?
Well, we're encouraging all our clients to basically use a barbell strategy. We have been doing this now for the last six months. Where there's still a concept where you got to be defensive and you got to protect against interest rates. Areas that clearly have strong balance sheets that have good concept of profitability that can maintain, and model through this environment that allows you to protect when you are in a down market. So that component obviously, has worked really well, especially in the last, quarter when equities did poorly. And at the same time, we've been working on this idea of rolling recoveries after rolling recessions. And if that is the case, and we see that the consumer, stays strong, and we see that the service sector stays, the driver of GDP, then clearly you want to start positioning yourself ahead of what the recovery might look like maybe in 2 quarters from now. So, on the predication that the Fed might be closer to the end, you want to position part of your portfolio to be ready for that recovery. And at the same time, because we're not out of the woodwork yet, then you want to still defensive on another part of your portfolio.
Omar, always great to talk to you. Great to have you on. Omar Aguilar there over at Schwab Asset Management, helping us count down to those closing bells, Scarlett, which are just about 3 minutes away here. And it's still lingering now, down about 1% across most of the major U.S. indices.
Yeah, you have 23 out of 24 industry groups in the red at the moment. I was just looking across assets to see what else is down. You figure with the stronger dollar, oil prices would be down, but actually they're higher. Which is interesting. That relationship sometimes breaks down, sometimes doesn't. Of course, the Israel-Hamas war kind of gets in the way of all of that.
Yeah, and let's face it, a lot of correlations have really kind of been upended for a wide variety of reasons here, and whether they revert back to the normal or whether this is now, to borrow a phrase, the new normal, remains to be seen. But what is normal is that closing bell. Coming up here with our full coverage as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast. We're joined right now by Tim Stenovic and a very special guest, Barry Ritholtz, sitting in today for Carol Master. Welcome to our audiences across our Bloomberg platforms, television, radio, originals, and our partnership with YouTube. Tim?
I thought stocks only went up. But I guess that, when you hear from Fed Chair Jay Powell, nothing new, then, sometimes stocks go down. The Fed Chair is saying, OK, well, we're still, not to 2%, but we're wedded to 2%. And we could still see some more tightening in the future.
Yeah, I thought it was kind of funny that we've been heading straight down since August, and we have a 8 or 9 day rally, and suddenly the Fed is nervous that animal spirits have been unleashed again.
Seemed like the market kind of wanted to be down today. I hate going to lame explanations like that, but after an 8 day rally, you need a reason to continue rising, and you didn't get any reasons to continue rising, so this is the default scenario. A default scenario that claws back just some of the gains here, but is that trend line, is it still up? I mean, because I think that's really what people want to know, right? You look at the long-term trend lines, and if you can make a case here that there is a longer-term story, then maybe you get more comfortable with that volatility, with the idea here. But it's funny, as we're speaking, guys, we're showing the Russell 2000, and that's been the big laggard. I mean, we talk about that 8 day rally, but that was an 8 day rally that was still kind of centered around the larger cap names and, more importantly, some of those tech names. Yeah, and since mid-September, the Russell 2000 has lost about 9.2% versus just a 3% odds slide in the S&P 500. All right, well, after an 8 day run for the S&P and a 9 day run for the NASDAQ, we're seeing red across the screen for all of the major indices here in the United States of America. The Dow Jones Industrial Average down 0.6% here on the day, roughly 200 points lower than where it was yesterday. The S&P 500 is going to close down by about 35 points, or about 0.8%, right around that 4,347 level, while the NASDAQ down about 128 points, or 0.9%. And we just mentioned it there. The Russell 2000 remains the laggard once again here, down 27 points or so on the day. That's about 1.6% lower.
All right, peeling back the layers of the S&P 500. Not every stock is lower. We've got about 125 stocks at this point that did move higher today. Scarlett, 378 did move to the downside. Yeah, but most industry groups are definitely in the red. You have 24 of them, and we have 3 that are gaining, but it's just barely. Insurance companies, household and personal products, and semiconductor companies barely in the green. On the downside, Tesla leading autos and components lower by more than 5%. Pharma stocks also losing 2.8%, and REITs under by 1.5%. All right. Well, I did manage to find some stocks in the green today, some barely hanging on there. Got to talk Disney right now, up by 6.87% on the day today. Disney shares rising after the company reported better than expected
round that
profit.
up to 7%, right?
6.7.
Okay.
Yeah, that's what I'll do.
You know.
You got to wait for it to settle sometime, Romaine. You know, that's the excuse I'll use.
He's impatient.
Shares rising after the company reported better than expected profit and vowed to cut $2 billion more in expenses. I will say, I imagine that the end to the actors' strike that lasted close to 120 days also not hurting sentiment for investors. Shares of NVIDIA.
But doesn't that mean their costs are now going to go up? I thought all the cost savings were because they weren't actually making anything.
Okay, yeah, but then you got to create content for people to go pay for Disney
That's
Plus and then go watch in movie theaters. Although not many people. I haven't heard great things about the newest Marvel movie out there.
Oh, the Marvels?
Yeah, I haven't heard great things. Let's talk about NVIDIA.
I feel like they're just running out of ideas because usually it's like individual movies. Now it's just the Marvels, right?
Yeah, that's the new one. Yeah, it's just all the characters.
I think they should just come out with a new movie called Comic Book. How about that?
Just team up with DC for that one, right? NVIDIA shares finishing the day higher by 0.8%, holding on to those gains after a report said that the company has completed designs of 3 new AI chips for China. NVIDIA now up for 8 consecutive sessions of gains. Is that right? Its longest winning streak since March. Look at that. And then Virgin Galactic shares SPCE. Okay, before we talk about today's gain of close to 20%, of 19.2%. We should note that shares are down about 47% so far this year. The company did come out and say that it was boosting its revenue forecast for the fourth quarter. It delivered third quarter revenue that was ahead of consensus. Also slashing 18% of its workforce, pausing space flights starting in mid next year. They're going to cut costs and focus on developing new launch vehicles. Shares of Virgin Galactic higher by more than 19% today.
All right, let's take a look at some of the decliners. There are plenty to choose from, so I went with the biggest decliner in the S&P 500, Becton Dickinson, off by almost 1/10 of its market value. The biggest decliner in the S&P, as I mentioned, the medical device maker gave a 2024 full-year profit and sales forecast that trailed estimates in large part due to currency rates. Corteva slumping to a 2-year low. That's another big decliner today. The ag company posted a quarterly loss and sinking sales. It's losing pricing power, and I suspect this is something that we'll see more of from other companies. It says the growth in prices will slow to a low single-digit percentage increase next year. Pretty ugly chart there. And Bill, it tanked as much as 16% after denying reports that it's pursuing any M&A right now. We had reported yesterday that the company, which makes financial automation software to small cap companies, is in talks to buy a digital payment company, but that's not to say that it won't make the purchase at some point. It's just not happening right now.
All right, let's take a look at the yield space because, of course, that's where a lot of the activity was, at least on a settled basis right now. You're looking at the long end of the curve up about 16 basis points, the shorter end of the curve, your 2-year yield up about 11 basis points, and the 10-year up about 15 basis points. But that really kind of obscures the volatility that we saw. On the 30-year yield on an intraday basis, we saw a 22 basis point swing at one point on the day here. You have to go all the way back to mid-March, the last time we saw a swing like that on longer-term yields. And that was largely due because of the unraveling fallout from the regional bank crisis that was just kicking off. Of course, the big unraveling today, guys, came because of that Treasury auction. And I started off here talking with Scarlett when she joined us on set here. I think the big number of the day really is that number that we got out of that auction, which is 4.769% here. And the gap that we saw that bidders had to take versus what was actually traded in the market before, that demand, it just continues to dwindle.
Yeah, what we've been hearing about auctions has been pretty interesting. There's also a story about a hack from one of the primary dealers whose entire system kind of, stepped off of the normal process. That could have some sort of effect here as well.
Yeah, and that was a big deal. And I mean, it's funny because a lot of people were scratching their head, ICBC, and everyone was like, what is that here? I mean, this is actually the world's largest lender in the world, by assets at least. And they're a huge sort of settlement shop for a lot of folks who are trading treasuries. So it's possible, it's certainly plausible that it could have had an effect. It might take some time before we get official confirmation.
But I guess the question is, if that is what moved the market lower when that auction happened, then why didn't we see when the news story came out that there was indeed some recovery? Was it what we heard from the Fed chair and about rate moves forward and that the Fed isn't done.
Yeah, well, think about the timeline. I mean, this happened early in the morning, right?
Yeah.
You did see some movement back in yields once that started to get resolved, or at least it started to become public. But then, of course, you had that auction. Then you had Jay Powell start talking, and I don't know. I'm sure somebody else said boo or somebody to something, and that's why we got what we got.
How does this set us up for next week when we get CPI? That's what I'm wondering.
Yeah. Yeah, it's a big deal. I mean, look, aren't the economist estimates, Barry? And I mean, I don't want to get too deep in the weeds, but we talk about going back down to 3.1%, which is what economists are forecasting, I believe, for the CPI report next week. But, a year ago, we were at 9% or so here. And I know 3% isn't 2%, but shouldn't we be encouraged by this, Barry?
100%. And keep in mind, 3% isn't 2%. Unless you actually measure housing appropriately. And if you look at someone like Cam Harvey of Duke, who's crunched the numbers, his takeaway is that if you use apartmentlist.com or even Case-Shiller, you end up with an inflation number in CPI that's under 2% because the Fed is working on very stale data. Owner's equivalent rent is not up to date remotely. It's not an especially good measure of housing inflation. And hopefully the Fed is aware of how far behind the curve they are in recognizing inflation has fallen pretty close to their 2% number.
One thing that I've been thinking a lot about over the past few days is what we heard from Fed speakers over the last couple of weeks, Scarlett, which is that yields are doing a lot of the work for the Fed. But since we heard that from Fed officials, we've seen yields come down and stocks move higher. So what does it mean that the Fed came out and said this, but in fact, the yields are not doing the Fed's job anymore? It seems like a kind of a dangerous little cycle.
The Fed's saying that turned the whole trend around, right?
Exactly.
I think
maybe they shouldn't have acknowledged it.
Just pretend it didn't happen. Omar Aguilar, who was just with us, was telling us of Schwab that 2/3 of the moves in equities can be tied directly to bond yields, which is pretty remarkable. Forget fundamentals, forget earnings. Day in and day out, the swings are dictated by what happens in the 10-year or the 30-year.
All right, guys, that is going to do it for our cross-platform coverage this afternoon. Thanks for welcoming us so warmly. That's beyond.
I like
the
that
bell.
Barry guy. You should keep him around.
We are going to keep him around. He's going to hang out with us for the next couple of hours. Check us out tomorrow, same time, same place. We're on Bloomberg Originals. We're on Bloomberg TV. We're on radio. And, of course, we're on YouTube.
All right, stick with us. Big conversation coming up here a little bit later in the program about artificial intelligence, some of the regulations around it, and the potential opportunities. Mandy Long, the CEO of Bigbear.AI Holdings, is going to be stopping by, as well as AI pioneer Jana. Stick with us. This is Bloomberg. All right, welcome back here. An interesting day in U.S. equity markets. That streak, that daily win streak that we had seen on the NASDAQ and the S&P 500, now officially over, ending in a pretty big way today with all of the major indices down roughly about 1% or so here on the day. But one thing I thought was interesting, too, is just how much the moves that we're seeing in the equity market are tied to the moves that we're seeing in the Treasury market, but also with regards to the volatility that we're seeing in that market. Believe it or not, on a lot of the days where we see Treasury volatility increase, we actually see equities prices increase as well. That was not the case today. We saw a little bit of a divergence there as some people got spooked. Could have been a lot of things. It could have been Powell. It could have been that auction, or it could have been some of that issues with that cyber attack that we learned about earlier in the day. The S&P 500 did close down 0.8% on the day. And you look at a 30-year yield that while it closed officially down, higher by about 15 basis points, we saw a move of about 22 basis points throughout the session here, an extreme move that we haven't seen since March of this year. NYMEX crude oil did move higher here on the day, and there's been a lot of talk right now about softness in the EV market. Palladium prices down 6% here, and we saw lithium prices track that as down as well here. But let's go back here to one bright spot here on the day, and believe it or not, Scarlett, that's actually Bitcoin. One point in the day, it was back above that 37,000 mark, and more importantly here, erasing all of the losses coming out of that terror crash about 18 months ago. So a little bit of a bright spot on one of the more speculative assets, but of course still nowhere near those all-time highs.
Is crypto back to being an uncorrelated asset? It looks like it, at least for today. We'll keep an eye on that for you. In the meantime, when you look at the public markets, AI, of course, has been one of the biggest investing themes of the year. And shares of software company Bigbear.AI, they're up more than 125% so far this year. This week, it announced it's buying Pangiam, which is a provider of vision AI technology. So joining us now, I'm pleased to say, is Mandy Long. She is CEO of Bigbear.AI Holdings. Mandy, it's so good to speak with you. I'm going to ask a really basic question here. What is vision AI, and how does it contrast with or complement generative AI?
Absolutely. And first of all, thank you for having me back. Vision AI, right, or another way to think about it is computer vision, is using advanced technology, artificial intelligence in this case, to be able to mimic one of the human's most powerful senses, which is the ability to see. And it's something that has been somewhat off limits or out of reach for us as technologists for a very long time because of the cost and lack of availability of high-powered compute. And what's changing now is that as the ability to develop and deploy AI models with particular focus, vision AI models, being able to do that in a very distributed way, it's an incredibly powerful place to be in.
So what does this acquisition of Pangiam allow you to do that you couldn't do already? How does it increase your total addressable market?
It's a great question, and something that strategically gets us really excited about the potential of the combination of these two businesses in the future. First is that Big Bear, right, we're an AI company focused on the national security mission that has our roots in defense, intelligence, as well as complex manufacturing in the private sector. Pangiam is a remarkable company that also sits in both the public and private sector and has a focus on near field. And what I mean by near field is that while we at Big Bear are focused on far field, meaning video cameras and looking at things that are far away, Pangiam is the complement to us, right? They focus on near up, right? Facial recognition and other advanced biometrics. And so the combination of those two things for us when we look into the future represents a very powerful and differentiated combination because we'll be able to do up close and far.
There's been a lot of talk about all the focus on AI this year, the hype cycle, the media hype cycle around it here. But when we get to the substance of it, Mandy, and looking a little bit longer term, do you think that the promise of AI is going to be more consumer facing, because that seems to really what dominated the narrative, or is this going to be more about enterprise and corporate customers trying to fold AI into their own products and services?
You know, Romaine, it's a great question. And I think, honestly, I will say I don't think there's a single part of our lives that will be untouched by AI. Right? We're going through the fourth industrial revolution, which is the intersection of cyber physical systems. And what that means is, regardless of whether it's my children learning in the classroom in a different way or a large enterprise changing the way that they deliver back office functions, I think we're going to see it everywhere, and it's going to happen much more quickly than we expect now that we've seen some of the massive unlocks that have happened in 2023.
Is there, I guess, discussion? Have you had discussions with any of your peers about kind of how companies work together on this? And I understand there's a lot of competition here, but when we talk about what AI is supposed to represent, about the potential for regulation here, I would think that the companies themselves would need to have some sort of melding of the minds to make sure that there is at least a base standard, a base industry standard out there for how they operate things.
I think that your point is really important. And yes, right, we, as well as many others in the industry, are spending a lot of time on this topic. Bigbear.AI has come out with several public comments associated with the regulation of AI. And our stance is one that I think puts us in a slightly different position because we are advocates of the open source and advocates of the community. And we believe a lot in tech regulating tech. And what I mean by that is not people, right, is infrastructure associated with being able to enable large scale adoption regardless of who built it.
And of course, we'll get to the regulation conversation in a moment. But Mandy, just looking at your bio, your roots are in what I call old school AI, having worked at IBM on the Watson franchise for a number of years. What kind of advantages or challenges did IBM customers who adopted the technology early on have versus those who chose to wait? I'm just trying to get a sense of what the pace of adoption of AI might look like in the coming years.
Another great question. I think early days, and I came in and was a absolutely privileged to be a part of Watson Health in some of its early years. And I think what we saw in trying to apply artificial intelligence to some of the most complex and highly regulated and personal experiences that humans have is that it is incredibly expensive, going back in time, right, about 5 or 7 years ago, to build highly tailored models that can support diagnostics. However, the technology itself is remarkable and has unbelievably powerful implications to outcomes for patients. Now, when I moved over and I started to work in more of the enterprise side of IBM and automation, I think what we started to see, and I think we're seeing that reflected now when you look at the operational adoption of AI, is that enterprises are very well positioned to be able to create an augmentation and extension of functions that see a lot of administrative demand, and are using artificial intelligence in those workflows. And that, I think, again, in my time at IBM, which I look back and, I think I'll always be a big blue at heart for the rest of my life, is that I felt like I got to sit in the front edges of how we started to see human behavior change initially at a corporate level. And I think what 2023 has seen is that now we're seeing a change at a personal level.
All right, Mandy, great to have you back on the program. Mandy Long there is the CEO over at Bigbear.AI Holdings, of course, a background at IBM. And we're going to continue that conversation in just a bit about the state of AI and some of the regulatory approaches now that the industry is going to have to contend with. Meanwhile, there was some breaking news, Scarlett, just crossing the wire. This on TKO. Of course, that was a mashup of WWE and the UFC here. We're now learning that WWE founder Vince McMahon is going to sell about $700 million worth of TKO stock here. It looks like about 8.4 million shares offered via Morgan Stanley. That's pushing the shares down here in after-hours trading by about 7%.
Yeah, everyone's wondering what he knows that no one else knows, or if this is part of a planned divestment or a planned pairing of its holdings. It's not clear. And of course,
yeah, you wonder if that is given his status with the company or lack of it, his age. And then, of course, remember, I can't remember, it was a couple weeks ago, there was a lot of talk here about Ari Emanuel maybe looking to take Endeavor public. Not this,
options.
Right. This wouldn't affect TKO in theory, but it makes you kind of wonder.
Definitely.
All right. When we come back after the program, we're going to get back after the commercial. Excuse me. We're going to talk about AI a little bit more with Jana Eggers, the CEO over at Nara, and get her insight on what's ahead for AI regulation. Stick with us. This is The Close on Bloomberg. All right, as the hype around AI settles, now a much bigger discussion about the substance and the potential risk here rising as the AI giants battle for some degree of dominance. Regulators now trying to figure out where they fit into the picture here. The Biden administration about a week ago unveiling an executive order that, in theory, would provide some degree of guardrails, at least here in the U.S. Jana Eggers joining us right now, a pioneer in this space. She's the CEO of the AI company Nara. Great to have you here, Jana. And I do want to start off with that executive order here. And it was very detailed, but there are a lot of questions here about implementation, but also about the idea of whether we maybe need a more global framework rather than just having individual countries setting the rules.
I think that we are, in general, as a global community, we are used to our own country setting rules, and because our societies are that way. So I think that's a good thing to start there, and then we can learn what maybe needs to be globalized. I was actually with one of the folks who helped write the executive order yesterday, and she gave us a lot of feedback. You know, one of the things that I love that she said is, you know, think about this as, you know, you're trying to drive a race car, you're trying to go fast. We're just trying to give you good brakes. And I really appreciated that she said, we want you to go fast, we just want you to have that control too.
Well, I'm curious. I mean, I had a chance to interview Michael Hsu, the acting comptroller of the currency. He actually used that brake analogy, the idea of why regulation is needed here. The idea is that you can go faster in a car if you have better brakes or you have more confidence in the brakes. But he also acknowledged there's a huge lag right now with the government trying to catch up to where the industry is, because you guys are just running full speed ahead with this.
Yeah, we are, but I'm actually really pro some of this regulation, and my reason is it makes people think, and that's really what we want to do. It's an executive order, it wasn't a law, so it gives us guidelines, and that makes people kind of take a step back and think about, well, what do we do now, and how are we going to measure ourselves? How are we going to make sure that we have the right access, the correct access to data and things like that? So to me, it just gives us some of those guidelines to check ourselves, and that's good. Like he said, the brakes are there, so let's pay attention to them.
Feels like the guidelines are speed bumps, really, causing everyone to think through before they move forward. But they're not laws, and at some point, Congress will make laws regarding this. What is your confidence that members of Congress understand what's happening here and are interested in understanding? They seem to have their mind on a whole bunch of other things.
Yeah, I think so. What I will say, though, is they do tend to turn to the experts, which I think is good, and they do have a diversity of experts that they're looking at. That doesn't mean they'll pay attention to them when they make the law, so hopefully we'll get there. But I do think that having something like this first allows them to get more feedback. If they just started with the laws rather than this, then I think that's a bigger challenge to get through. So
they can tap a diversity of experts, but do Republican experts look at AI in a different way than Democrat experts?
Of course.
When it comes to AI, I mean, you can find someone to back up whatever position you want.
Absolutely. And that's why, it's one of the great parts about our country is the two-party system. Maybe we need a little bit more diversity there, and we're getting a bit polarized, so bringing more to the center. But you are getting both of those in there. And so you're not getting just all Republican and all Democrat. And a lot of tech people span. So I think it's, we'll get the right feedback in.
But there's also the issue of kind of the dynamism of AI itself or AI development, and whether the regulations or any laws that crop up around them are also going to be dynamic in nature, because as you know, I'm sure a lot of regulations and laws are very static and they're sort of set in the time in which they were written. And if AI is moving that fast, does it end up becoming obsolete very quickly?
I think if we focus more on those end results that we're trying to get to or trying to prevent from happening. So think about car emissions, right? We want a certain amount of car emissions. You can make engines in a lot of different ways. I think it's the same kind of thing that you can do with AI is really, and that's where I think there's a problem. There's a lot of focus on the technology and not as much focus on those end results and those use cases and what's good for each of those. So I'm not a car person, so I hate using all these car analogies.
Me either. So where's Matt Miller when you need him? So, but that becomes more an issue of focusing on the models or focusing on the AI systems overall?
That's such a good question. So I have this analogy
and you've got
that
20
I use.
seconds to answer.
Okay, I call it the chicken, eggs, and bacon of AI. Okay. The bacon is the use case, right? That's the thing we all love. The eggs are the data, and the algorithm is the chicken.
All right.
So,
Jana, we're going to have to leave it there,
Sorry.
unfortunately. No, that's my
great.
fault. Jana Egger, CEO of Nara Logic. Stick with us. Interesting day in U.S. equity markets here. Kind of a bookend of that big rally that we had coming to an end today after 8 straight days of gains for the S&P 500. And those bookends, well, it's the same. Jay Powell, remember that rally basically started on the back of comments that he made that seemed to suggest that rate hiking might be over. But then new comments today making it clear here that the fight against inflation will carry on with or without the market's cooperation. The S&P 500 down 0.8% here on the day. Most of the other major indices moved lower by roughly about 1%. And of course, most of the activity today, once again, was in the yield space. That was where the volatility was. That was where the volume was. Your 30-year yield, 16 basis points higher than where it was yesterday. Your 10-year yield, Scarlett, 14 basis points higher.
It increasingly feels like equities is a sideshow to the Treasury market, right? Which is supposed to be stable and not so exciting, but hasn't been the case.
Yeah, absolutely.
All right, let's return to earnings right now because Lionsgate has come out with its second quarter results and it did report a beat on an adjusted EPS basis. Second quarter adjusted EPS of 21 cents. Analysts were looking for an estimated loss of 7.5 cents a share. Not clear that we're comparing like with like here. Also, Lionsgate is reaffirming its guidance for the full year, even with, quote, the negative impact of the strike. Bloomberg's Lucas Shaw is in Los Angeles with more. And of course, the strike that they're referring to, the actor strike, has now ended. It's interesting that they would cite the negative impact when I thought most of these media companies have done better because of the strike because they weren't spending as much.
Well, look, the companies can save money in the short term because they're not spending as much, as you note. But if you're a company like Lionsgate, they're primarily a studio. You know, they don't own TV networks that continue to collect affiliate fees and advertising money. They don't have streaming services, or at least not at the same scale as others that continue to collect a lot of revenue. They need to be able to produce shows and to sell shows, and they haven't been able to do that for several months. You know, they have the Starz streaming service, but it's considerably smaller than Netflix or Disney or Amazon.
Where does that fit in, though, into the current landscape? Because it's kind of interesting to think about the history of Lionsgate, and you know, I mean, they were kind of the darling for a while, at least in terms of critical acclaim here. But that was a much different movie market, a much different television market back then when they really had their heyday here. Has, I guess, the industry kind of passed them by, or is there some sort of adjustment they can make?
Well, they're one of a few companies that is a little small for the current moment in Hollywood. You know, they had a good kind of period of counterpunching, if you will, where they were sort of this mini major studio. They had the Twilight franchise, the Hunger Games franchise, and have continued to do well with things like John Wick. You know, they're a very good producer of television shows. You know, they were behind Orange is the New Black, among many others. But they're just kind of a subscale player when you look at the size of Netflix or Disney, and certainly Apple and Amazon. And they spent a lot of money kind of merging or buying Starz, which was supposed to be one of their answers in the streaming universe. And Starz is really subscale, which is, I think, one of the reasons they're now separating it, because there's more value in the studio than there is in the streaming business.
Does that mean that streaming business is going to be up for sale? I mean, can a smaller streamer like Starz survive in this era of higher salaries and higher costs?
You know, that second tier of streaming services, I think, has a hard time. Whether they're up for sale or whether they try to bulk up will be kind of depend on what happens when this split happens. But they've been talking about this thing for more than a year now.
Do you anticipate that we could see, I guess, some degree of some meaningful consolidation in the industry, Lucas?
I mean, look, that's the expectation for 2024. I would say you've got companies like Lionsgate and Starz, like AMC Networks at a bigger level, like Paramount, like Warner Brothers Discovery, to some extent Comcast, where people see them as wanting to either buy something or sell or do some transaction, because there's just too many mass market streaming services, or more mass market streaming services than most of us are going to be willing to pay for.
All right, Lucas Shaw, our man out there in Los Angeles here, keeping an eye on Lionsgate and really the broader Hollywood space right now, as a lot of folks now turn their attention back to the actors who are scheduled to go back on the job. SAG-AFTRA labor union striking a deal with the Hollywood studios to end a more than 100-day strike. This is about a month after the writers agreed to go back to work. Eunice joining us right now. She's assistant professor at the University of Utah's Department of Economics. Talk a little bit about some of the labor strife that we saw coming out of that. And I am curious, Eunice, as to whether this was all worth it. I mean, we knew this was a strong labor market, and we knew that sort of emboldened a lot of these unions to ask for things that, quite frankly, they have been asking for years. Did they get everything they wanted?
Well, so when workers go on strike, it's pretty much the end game, right? They've been trying multiple times to get their needs met, but didn't work out, so they go on a strike. So both employers and employees have a lot to lose when they go on a strike. But I think the cost of strike is much higher for employers these days. I call this a prime time for unions. So unions have momentums these days.
Do you
public
think
approval of labor unions are at the highest at the 60s? So these are all kind of a good signs for unions. So they can ask a lot more.
How long do you think those good times are going to be here? I mean, we know that the labor market was somewhat distorted in favor of workers over the past year, but most people are starting to see some softening in the labor market. If that does indeed continue, does that lower the leverage that unions have?
Very good question. So when economy bounced back from the COVID pandemic, our labor market experienced labor shortage, right? And then economy remains strong. That means despite some domestic and international challenges, it's kind of overcoming those challenges. So high interest rate, high inflation rate, those can cool down the economy, but didn't happen just yet. And the wars outside the United States, they can also bring instability to the economy. But still, the multiple indicators for the market performance show that our economy remains still strong enough so that workers have other options to turn to when things get sour in their workplace. That also means the waiting period for workers is not as painful as in a recession. So these circumstances kind of give workers more bargaining power during negotiations. So when we face the recession, that's a different story. But right now, we're not there yet. So still have a good bargaining power going on.
Eunice, how do you see the resolution of this strike playing out in jobs across the U.S., especially as we look towards the November jobs report that comes out in December? Because we know a lot of actors who weren't working were working in the restaurant industry at the same time that the restaurant industry was shrinking its workforce and holding on to the talent it did have. This is going to create a lot of ripple effects.
That's right. So we will have to see, right? Because multiple indicators are playing a big role. So we can't just rely on a single measure. So like in the most recent report, the number of jobs being added, they were consistently high for the several months, and jobless claim did fall, but we have historically low unemployment rate. So all these they can tell the different stories, but so far the news has been kind of consistent that we have a strong labor market still. And as time goes by, when these effects kind of trickle down, and we might see a different story going on in the labor market. But for now, I'm guessing that we will have this going on for a while.
Yeah, well, pay was obviously issue number one for the writer strike and for the actor strike, but AI was also a very big issue here in the actors versus studios dispute and the writers versus studios dispute. How do you see that coming up as an issue, as a wedge issue for other unions across the economy?
Well, so if you want to compare this to like a labor unions in the auto industry, so what they were asking is pretty typical, right? When we can see this like higher pay and better working condition, that's been a typical negotiation points. But for this SAG-AFTRA negotiation, it was a little different because a lot of elements they are negotiating for, it's kind of a new in the labor market. Like AI is one of them, and streaming, and then how to divide the residual, stuff like that. We don't have many precedents about that. So it takes some time for both parties to really understand what's going on. So that's why it probably took longer to have this tentative deal. So I'm not an expert in the AI and in how to divide the residual and stuff like that. But what I see happening here is kind of we are entering the new realm of the labor market where things are new, right? So we need to write a new laws. We need to write a new policy related to all this. And again, that's going to take some time. And we don't even know what's fair and what's not fair. But I think the workers understands better about what's fair in this case, so they negotiated to their terms.
All right, Eunice, it's great to catch up with you. Eunice Han there, she's an assistant professor at the University of Utah in their economics department. A closer look here at the labor strike, Scarlett, and of course the resolution of the big labor strike that everybody was watching, which was the Hollywood actors. But we should point out we had the casino workers reached a deal as well here. And of course we know with the auto and the healthcare workers as well here. So some of these are being resolved. And it does look like some of these labor groups did get a good portion of what they were asking for originally. Yeah,
they did after a lot of pain on the company sides. Think of Carol Tomei, the CEO of UPS, and how ahead of the curve she was.
Yeah, how quickly. And we talked a lot about that, how, she's
she made sure that it was not an issue going forward, and she got it done quickly. There was pain involved, but she got it done quickly.
Yeah, before we go to break here, we got a lot more coming up on the show. I do just want to go through some big after-hours movers here, because there's some big decliners here. Trade Desk out with earnings here, and they had a big miss. You see the shares down 28% here. And there's a lot of concern here. Remember, this is tied to digital advertising. Trade Desk is a digital advertising company. We saw that softness with Warner Brothers Discovery, and now this is apparently showing up there here. Their EPS did actually beat here, but it's more about the guidance, more about the forecast here. Revenue coming in at $580 million for the fourth quarter. That's well below what the street was looking for on average. And then Unity Software, which has been kind of a basket case. Everyone has really been dumping on this company for some mismanagement and other things that they've done. done. Those earnings were out. And once again, really coming in below expectations on a lot of levels. These companies now basically saying, no more forecasts because we don't have the clarity here. And they're basically telling investors, this is wait and see. And as you see there on your screen, Scarlett, they're not waiting to see.
Yeah, well, maybe it makes more sense to be upfront right now and then hope for the recovery later on and surprise on the upside. If everyone's giving these disappointing outlooks, now's the time to do it.
I was most surprised by the name at the bottom of the list. I always forget Groupon's still around.
I know. I was just thinking the same thing. It did report a loss for the quarter, which I guess is not that big of a surprise because I can't think of anyone who actually uses a Groupon.
Yeah, that's right. And, they, of course, had this reverse split there, kind of keeping the shares afloat there. Wynn Resorts also lower here in after-hours trading.
This is just run-of-the-mill declines now.
Illumina, right. I mean, 5%. I mean, compared to 28% and 13%. All right, a lot is moving here in after-hours trading. It'll be interesting to see how that folds into the cash session tomorrow on Friday. But stick with us here on this Thursday. A lot more coverage coming up, including a sit-down with Jana McCarthy, the former head of the EPA, to talk about climate change. That's coming up after the break. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment. David Weston had a chance to sit down with Jana McCarthy, managing co-chair of the coalition America is All In. That's what it's called. She's also, of course, the former administrator of the Environmental Protection Agency, and they had a chance to discuss the health aspects of climate change. Let's take a listen.
Health doesn't seem to be an issue that people are connecting with the issue of climate change. And it's really important, I think, to make sure that people understand that there is a link between air pollution and our dependence on fossil fuels. Look, personal health and the health of our planet are inextricably linked. And we know now that 99% of people around the world are breathing dirty air that does not meet WHO standards. And that is contributing to 7 million premature deaths every year and 500,000 kids. That's amazing numbers. So my effort is to try to get the word out that we have to do better than this. We have to connect both the challenge our planet is facing on climate change, but look at resolving that by recognizing that there are opportunities that we have to also tackle this health crisis while we continue to invest in resilience and adaptation in climate. I just feel like it's a missing piece of the equation that can make the climate challenge both relevant to communities all across the world, but also a huge opportunity for both public and private sector investments.
Let me pick up on two things you said. We can do better and we can make it more relevant. You've really devoted yourself to climate and addressing the problems with climate. There's a sense on some people's part that we may be losing a bit of momentum. We're having difficulty funding some of the lower income countries and what they need to do. Electric vehicles are not as popular as they once were. ESG has gotten a bad name in some parts of the United States, at least. Are we losing momentum? Is there a risk here?
You know, I don't think so. I think we have to make sure that we really continue to control the narrative here, because it's important that real information be given to people. And I think there's a challenge, you know, that addressing climate change poses to fossil fuel companies. And I can see that, you know, eking into conversations even in the United States, in rural communities and others, where these issues are being posed in ways that I don't think genuinely look at both the benefits of climate action, but also the extended way in which we can make this benefit people. Look, the IRA that was passed during the Biden administration is just an amazing way to jumpstart this transition to clean energy. It's $370 billion investment, and now it's investing in 388 projects across 45 states already in just a little over a year. And that has created 210,000 clean energy jobs. It's just amazing. And this is an opportunity for us to basically recapture the narrative, David. You're right. All my life, I've been trying to figure out how to translate these challenges, especially global climate change, in a way that makes it relevant to people, but also that brings real opportunity with it. The IRA is just that. It's actually investing in our future, and we're investing in the United States again. We're rebuilding our manufacturing sector in the Midwest. We're kicking butt on electric vehicles. So I know people are raising issues and concerns, but we've grown 210,000 clean energy jobs with the IRA resources. So we are moving forward.
How do you get from international agreements in faraway places and even federal programs down to the individual, to the local level, to the states, to the cities, the communities, to make this less abstract? Because as you suggest, a lot of it sounds pretty abstract and pretty much removed from me and my personal life.
Well, David, that's why I actually, after I left the White House, I joined Bloomberg Philanthropies to do work to actually do exactly what you're talking about. Look, change happens from the bottom up. That's my experience. And I've worked at every level of government over more than 4 decades. And what you begin to realize is the federal government is great when it's pushing, especially with benefits like the IRA produces. But you need to build from the bottom up. So I joined Bloomberg Philanthropies because they have a program and a project they've been working on for a long time to basically get local engagement, state engagement, subnational engagement in both moving this climate change effort forward, and also to basically make sure that we can do that working in the global context as well. So I am now a managing co-chair at America is All In. I am traveling to make sure that people know what's in the IRA, know how to access it, and to begin to more effectively engage a coalition that's now more than 5,000 of leaders at the state and local levels, leaders of corporate America, leaders of the healthcare sector. We can all work together to figure out how we supplement what's going on in the federal level and supercharge it to make sure that we are moving forward as quickly and effectively as we can. And that's where we can personalize this, David. That's where we bring the benefits home to people. That's where people see that manufacturing is growing and jobs are there for them again. That's where people can see that their health is improving because we no longer have the emissions of fossil fuels that are contributing to these premature deaths. That's where we can focus to make sure that environmental justice communities finally get the investments they deserve.
And Gina McCarthy speaking there, former EPA administrator and now managing co-chair of the coalition called America is All In, the conversation about climate change. And just a reminder, you can watch more of our conversations from Wall Street Week every Friday when Wall Street Week airs at 6 p.m. New York time. All right, still ahead here on The Close, we're going to set you up for what investors will keep their eyes on tomorrow. This is Bloomberg. Interesting day in markets today. Some of that driven by Jay Powell, some of that driven by kind of a faulty Treasury auction, if we can call it that, an ugly Treasury auction, and really just a lot of concerns right now here about where we go next in the global economy. And we talk about what folks are going to have their eye on tomorrow here. We, of course, have to go back out to the Bloomberg New Economy Forum. We are going to hear from a couple of prominent people.
Yeah, and I'm sure the topic is going to focus on climate change because you have Mark Carney, who's the UN Special Envoy on Climate Action and Finance, and of course John Kerry, who's the Presidential Special Envoy on Climate. They're going to big thinkers on what the cost is and what the benefits are and what, of course, the challenges are in addressing climate change.
Meanwhile, we are going to get some more economic data, and we go over to the United Kingdom. We're going to get a read on their gross domestic product here and the health of their economy.
Yeah, and it's not looking good. The estimate right now is for a 0% increase after an 0.2% increase in the month of August for overall GDP.
I wonder whether the issues there are just really specific to that nation or whether there's something broader going on over in Europe writ large here. We're going to hear from Christine Lagarde, the head of the ECB, tomorrow morning.
So watch for Christine Lagarde moving the euro. Of course, that's they have one mandate versus the Fed, which has to deal with inflation and, of course, full employment.
Yeah, absolutely. And coming back here to the U.S., we're going to get that University of Michigan data here. It'll be interesting to see where consumer sentiment is right now.
Absolutely. And of course, we know that the job market's fairly tight, so that's lifted consumer spending, but people aren't feeling that great about the economy. Of interest will be what investors think, what consumers think about inflation in the next year. Right now, it's at 4%.
And how about just the next month and a half as we head towards the holiday season, Scarlett?
Absolutely.
And more Fed speak. I know you're a big fan of Fed speak.
What are they going to say that's different from what Jay Powell said today?
Scarlett, there's nuance. There's nuance in there. All right, be sure to tune in tomorrow where Scarlett and I will break down all of that nuance for you. Balance of Power is coming up next here in the U.S. This is Bloomberg.